Lauren Weymouth speaking to you from Ripple headquarters. Welcome back to Ubri Connect 2020. If you joined us late last night, I hope you have a fresh cup of coffee. I haven't had mine yet, so thanks for bearing with me as I tell you all about the fantastic lineup of content coming your way. So we'll begin the show with 3 former U.S. Treasury members discussing CBDCs, central bank digital currencies, Michael Barr, Adrian Harris, and Lev Menand. Then Zoe Cruz will lead a discussion featuring Rena Argawal, Jim Angel, and Sylvia Bartolucci on digital asset adoption. Just like Galaxy Digital hired a Goldman Sachs partner and Jack Dorsey just bought 50 million in Bitcoin, these finance experts will really bridge the gap between Wall Street and crypto. The rest of the show will focus on industry updates by RippleX, formerly known as Spring, the developer-focused arm of Ripple, building open source tools, including the recently released PayID protocol. Ripple's CTO, David Schwartz, will be giving a keynote on the Internet of Value and payments. David is one of the original architects of the XRP ledger. And we'll hear from the CEO of BitPay, Stephen Pear, who will share some larger trends in the crypto space. He'll be followed by Joey Krug of Pantera Capital, who will discuss one of the most popular trends in crypto, DeFi, and how it relates to payments. We then have a ton of really interesting demos from you by BitPay, Crypto.com, BitTrue, Tangem, Payburner, PayMe Plus, as well as some technical demos by the Ripple team on using the PayID protocol. These will move really fast. They're 5 to 10 minute segments. Developers are going to want to stay through the end because Jen Yu, VP of Growth and Operations at RippleX, will close with an exciting new grant program. Remember, you can use the chat throughout the day to ask questions to our presenters. We're awarding prizes courtesy of the Block Research for the most engaged schools as measured by Q&A, sessions attended, and networking. Let's get started. Over to you, Michael, Adrian, and Lev.
Hello, everyone. Welcome. It's really great to have you all here joining us. My name is Michael Barr. I'm the Dean of the Gerald R. Ford School of Public Policy at the University of Michigan. I'm here with Adrian Harris, Professor of Practice at the University of Michigan's Ford School, and Lev Menand, who is a lecturer and fellow at Columbia Law School. All 3 of us are former U.S. Treasury Department officials, and we're delighted to be with you here today to talk about central bank digital currency. We're going to have really an informal conversation, and I hope you enjoy it. We should have a moment or 2 for questions at the very end. And thank you for joining us today. I'm going to kick it off, Lev, perhaps with a question for you to get us started, and then all 3 of us could join in. There are lots of different ways of approaching the development of a central bank digital currency. 2 big categories are account-based approaches and token-based approaches. I'm wondering if you could just get us started by helping us understand the key differences.
Yeah, sure. Thank you, Michael. So perhaps the best place to start is with account-based. CBDCs because they are probably the most familiar to everyone. An account-based CBDC would be just like a bank account, except at the central bank. And account-based CBDCs, they actually already exist, but they're generally available only to an exclusive clientele, namely banks and various government entities. So for example, in the United States, most banks have accounts at the Federal Reserve. The US Treasury has an account there, and the balances in these accounts are digital ledger entries. They're called reserves, and they're structured just like the deposits you or I might have in our own banks, like if we have a bank account at, say, Citigroup. So reserve accounts are extremely attractive. They're non-defaultable sovereign money. There's no deposit insurance limit. They pay a high interest rate. In the US, this is known as the interest on reserves rate. Payments between these accounts clear instantly. They offer fraud protection and customer service. So if something goes wrong with your account, there's a person you can call at the Federal Reserve, just like you could call someone at Citigroup if something goes wrong with your account there. And now for the Fed to offer these accounts to millions of people, instead of just thousands of banks, it would obviously need to build out these retail services. But in concept, the Fed could do something similar to what banks are already doing, using banks or not, depending on how they design the program. A token-based central bank digital currency is quite different. It would attempt to mimic cash. But there are limits to how similar a token can be to cash, because a token is not actually a physical object like cash, a token-based CBDC. It's called a token, but it's not actually a physical object. A token-based CBDC is actually technologically a lot more like an account-based CBDC than cash. It's a ledger entry. And it's a ledger entry designed to have certain cash-like properties. For example, a token can be recorded in a distributed ledger so that people can exchange it with each other without the involvement of a central counterparty like the central bank. So token-based CBDCs are sort of like the rabbit-duck illusion. Their advantages are their disadvantages and vice versa. For example, you can lose your token just like you can lose cash. There are no tellers to call if your token is stolen. In theory, you can anonymize transactions made in tokens. In reality, everything is recorded in a digital ledger, so whatever procedures are put in place to keep token transactions private could probably also be put in place to make account transactions private. Another duck rabbit feature of tokens is how they plug into the existing money and banking system. So an account-based CBDC would be seamlessly integrated. If you have an account at the Fed, you can immediately write checks and wires to other bank accounts. If you have a token, you have to go through a bank to make payments to people with account balances. So tokens preserve the positions of incumbent financial institutions. They do not clearly substitute for the account balances those institutions already provide. Nonetheless, tokens could be quite disruptive to the status quo, and this is largely because it will be hard to limit the uptake of tokens. So say, for example, the Fed issues only $1 trillion in tokens, hoping to keep most of the money supply it deposits in cash. What happens if people want more tokens than that? The central bank could be in a bind. If it does not issue more tokens to banks to give to their customers, the value of tokens might exceed par. A $1 token could end up being worth $1.10. So no matter what shape a CBDC takes, it's likely to have substantial effects on the structure of our monetary system.
Thanks, Lev. That's a great way of kicking us off. I think that both these kinds of systems of central bank digital currency, pose some real questions. I wonder, how you think and how, Adrian, you think about the potential disruption of account-based systems to our system of fractional reserve banking. Are we going to eventually end up in a place where if the Federal Reserve, for example, pursued an account-based approach, you'd get disintermediation in the banking system? And would the Federal Reserve then need to make credit allocation decisions? Is it lending in the economy too? Or how do you see this playing out really, in real terms on the ground? Maybe, Adrian, you could kick us off on that. And Lev, I'd love your thoughts too.
Yeah, absolutely. Well, I think, it's probably unlikely in the US that we would have a completely disintermediated system, right? We've got a system now where we work, as you alluded to, Michael and Lev, through the banks to get money to most of the population, right? Save some of these government entities and corporations, as Lev mentioned. But the rest of us get our accounts and use our money through a system of commercial banks, the JP Morgans, the Citigroups of the world. It's conceivable that the Fed or another central bank could take on an accounts-based approach and disintermediate the banks. It's also conceivable that you could have a blended option of these things, right? And that consumers could choose whether or not they wanted to have an account at, say, the Fed, or continue to have their account at a JP Morgan Chase, a Bank of America. And so I think we'll just have to see how things develop.
And I guess the Fed could decide to offer its Fed accounts through banks rather than directly, rather than taking on a retail role.
Absolutely. So one approach is to partner with banks and have the banks perform the customer service and the fraud protection on behalf of the federal government, on behalf of the central bank. And so the Fed account holder, as it were, would still hold sovereign non-defaultable money for which there's no deposit insurance because none is needed, but you're still interfacing with a bank that is performing various services on behalf of the government. And in many respects, such a model is a continuation of the current design where the deposit balances that banks, privately owned banks, issue are largely backstopped by the government already. And part of the reason for the privately owned banking system is to keep the government out of credit allocation and also to have the private sector play a role in managing the day-to-day business of payments.
Lev, do you want to maybe kick off the next series of questions?
Yeah, sure. So I think a good question to go to now, and maybe this one's for you, Michael, is to what extent do we see central bank digital currencies as a good solution for financial inclusion, as a way to improve access to the money and payment system for current groups and populations that are perhaps excluded?
Well, the short answer, Lev, is I'm not sure. I think the case really needs to be made. The upside potential would be that with more direct access to the payment system, you can lower the cost and improve services for low-income individuals. They potentially could be able to get their funds faster and at lower cost. I think that the real question is whether financial inclusion would be prioritized in any new system. Right now, we have a system payment system that doesn't work very well for low-income households in the United States or globally. So to come up with a payment system that actually serves low-income households, you need to be intentional about it. You need to start with the idea that that's your goal, and you need to build a system that meets their needs. I think it's really an open question whether central bank digital currency is the easiest route to do that, or whether improvements to the existing payment system would get you there faster. Moving to real-time payments would certainly, in many ways, help low-income individuals. Getting rid of the period of float that financial institutions hang on to funds and providing those funds directly when they are available, when they come into the bank to low-income people. And then figuring out how to expand access to appropriate products and services for low-income people. It's not just about having access to the account. Is the account set up and designed in a way that meets your needs, that helps you have control of your own funds when you need them, that lets you make payments when you want to make them. And I think moving to central bank digital currency could help solve those problems. So could to improving the existing payment system. I think that both really need to be explored. And I think it would be good to be skeptical about that in advance and hold people's feet to the fire to say, if you're really serious about financial inclusion as one of the goals of central bank digital currency, show me that you're designing it to meet that goal first.
Absolutely. And Michael, I'll just say, I mean, I completely agree with you. The design and the intentionality is so important here. So it's all well and good to say, well, here's this silver bullet that we could use to fix this problem around financial inclusion or around real-time payments. But it really does have to start with the intentionality of saying this is for financial inclusion purposes, this is for speed purposes, and building a system that then engenders trust in the very population it's meant to serve. I think part of what people find appealing about CBDC and Fed accounts potentially is not just speed, but also this issue around fees. We all know that often low-income consumers end up getting saddled with ridiculous fees from their banks, whether it's minimum balance fees or overdraft fees. And certainly there is a design of account-based CBDC that could solve for that. But it does have to be the intention of the government, the intention of the stakeholders to make that happen and really solve the problems. And I think you're absolutely right. It's completely an open question. Do we need to move to a completely new system or add on these new features, or can that be accomplished with the system we have today?
How do you all see the competitive landscape here? I mean, you've got lots of payments, mobile payments happening around the world that provide a lot of convenience for consumers. Most of those are riding kind of on the old payments rail, on the credit card system rail or the banking system rail. How do you see CBDC and crypto more generally competing in that space? Is it a competitive product, a complementary product? How do you see the competitive landscape playing out?
So I'll jump in here. I mean, I think, certainly in the near term, we're going to see these things as complementary products, if for no other reason than change management is hard and slow, and especially if you're talking about something as large and as global as the payment systems. So I think there'll be some time here in the future, the next 5 years or so, where we're seeing all of these payment systems, whether it's credit rails and debit rails and different kinds of digital currencies and fiat digital currencies, all sort of overlapping and providing consumers with a lot of choice, which can be a good thing. There may come a time when some of these things become fully replaced with either fiat digital currencies like CBDCs, or we may stick with a landscape that does have a range of options for people both domestically. You might have a different set of options when you think about cross-border payments. But I do think that progression, even if we were going to go to a completely new system of just CBDC, is going to take some time. So in the meantime, we will have, I think, a highly competitive landscape, and we'll see how consumers operate with it and what they choose to use and for what purposes.
I would just add to that. I think Adrian's got it exactly right, is that design, again, will really matter here, just as it matters for the financial inclusion. And so the public central banks will have a choice about how to design their CBDC offerings, and how they design them will really have a big impact on what role other forms of money are likely to play in the coming decades. And if we go with an account-based system that uses banks, that's going to have one sort of shape to it. If central banks pursue some type of token solution that maybe stays within domestic borders, there will still be a lot of demand for and room for private cryptocurrency solutions that potentially ease cross-border payments. And so the coming years are going to tell us a lot more about what the coming decades look like as central banks start to make critical decisions about the design of their potential offerings.
I think that's right, Lev. And a lot of energy for CBDC seems to have risen from two kind of primary pushes. One is countries thinking about the rise of private cryptocurrency and thinking that they needed to compete. In particular, when the announcement was made about Libra, the potential Facebook-backed cryptocurrency, that seemed to have accelerated moves all over the world in examining central bank digital currency as a competitor to private cryptocurrency. And of course, there's a basic dilemma whenever you have private money creation that at the end of the day, either somebody's really going to lose badly or a government somewhere is going to step in a crisis and make it public money. We've seen that through hundreds of years of the history of currency. So countries may be worried in that score. And then the second major impetus, I know both of you done some thinking about this, is other countries looking at the dominance of the US dollar in global markets and thinking that digital currency might help those countries compete more effectively against the dollar as a reserve currency. We've had explicit statements to that effect from Cambodia. Certainly, a lot of people think that's behind China's strong push into digital currency. And even the EU, as recently as last week, was talking about digital euros as a counterweight to U.S. reserve currency's dominance. So how do you guys think about this? Are these good motivations for pursuing CBDC? What do they lead you to think about the shape that countries are going to take in this way in the future?
Yeah, it's a great question, Michael. So it's not surprising to see that the various countries that are exploring this are quite concerned with their monetary sovereignty, because control over the money supply has always been of core concern to states, to governments. Governments use money to tax and spend, and it's literally the lifeblood of the state. And states that lose control of their money and the ability to modulate their economies by modulating the supply of money within them can tend to really hit on hard times and can really struggle. And so it's not surprising to see even a country like Canada in exploring CBDC options say quite explicitly, we may not go down this road, but if there's any doubt that the Canadian dollar is going to be the primary or near exclusive means of payment within the domestic Canadian economy, then we are prepared to pursue a Canadian dollar CBDC. And so I think a lot of countries will end up in that sort of posture where they don't necessarily plan as to introduce either a token or account-based digital currency issued by their central bank, but as a plan B are prepared to do so if they see other countries or private organizations issuing such tokens or account-based digital currencies that then get take-up within their economies. Then there's a different category, I'll just add, a country like China that might have an actual desire to not just protect the monetary sovereignty, its own monetary sovereignty, to ensure that the yuan is the near exclusive means of payment within China, but actually aim to promote the yuan as a means of payment in other countries around the world. And there's a lot of reason to believe that China, which is at the leading edge of central digital currency design right now, has very much in mind the possibility of exporting the yuan to other countries in the years to come.
Yeah, I think Lev is absolutely right here. I mean, different countries have their different motivations for exploring CBDC. From the U.S. perspective, though, I do think it is, as a policy matter, something that the U.S. government, that the Federal Reserve should be very attuned to as we look to maintain the primacy of the U.S. dollar as the global reserve currency. And obviously, there are more factors at play here than just the digitization of a fiat currency. There is trust and stability and the size of the economy. But But all of those things, right? I mean, it's not just that China is moving so quickly on a CBDC, but the size of their economy, their stability. If you think about them as a very large global player, certainly, but as you think about their relative strength in Asia, and so U.S. policymakers certainly have to be attuned to these dynamics and can't rest on their laurels.
I think that's a really important caution, Adrian. And I do think, you're going to see very aggressive moves by China trying to expand its own digital currency in the coming months and years, in part because of that broader role it wants to play and is starting to play on the global stage, perhaps starting with Asia, but more broadly, I think there's a desire to displace the U.S. Role in that area. You've seen some indication from the U.S. Federal Reserve that it's starting to take this issue seriously. Governor Brainerd announced that the Fed is conducting studies, some on its own, some with MIT, trying to think through the mechanics side of the issues. The Deputy Treasury Secretary has indicated that Treasury is looking at these issues. So I do think you're seeing some movement in response on the U.S. Side as well. It'll be interesting to see how it'll play out. One of the things people think about in terms of central bank digital currency is could relief efforts around the world have been deployed more quickly in COVID-19 with a central bank digital currency as a backbone? I wonder, have you guys seen any movement in this that is promising, countries that are doing a good job getting out COVID relief quickly? Any examples or suggestions you get from that about the way in which technological innovation might advance benefit payments around the world?
Certainly. So, in a country like Germany, where there's already extremely high bank account penetration, 99% plus, a CBDC doesn't necessarily offer much, would not make much of a marginal difference in helping the German government make emergency aid payments. And in fact, I think we saw earlier this year, the German government was extremely efficient and effective in pushing emergency aid payments out to its citizens. In a country like the United States, however, where bank account penetration is substantially lower, where there are millions of households that do not have bank accounts, the COVID crisis has really revealed a problem in our money and payment system, and an acute problem, especially in the case of a pandemic, because the government has no way of sending money to these households quickly, can't send it digitally. And when the government sends these households a check, the households have no account to deposit it in. And so they end up using expensive check cashers, and they have to go in person, which raises community transmission problems, tens of thousands of people physically transacting, in some sense, unnecessarily. If you were able to have some type of public option for digital money, or some type of arrangement that brought up the amount of banked households to 99% plus, it would be much easier for the government to push out emergency aid payments instantly, digitally, and safely.
Thanks, Lev. Adrian, further thoughts on that?
Yeah, I couldn't agree more with Lev. I think if we had a more direct way to get people aid money without not just them having to go to check cashers and pay fees, but also without that time lag that's created by having to send checks. And frankly, even the time lag with the existing payment system as we know it today, I think that would really be to the benefit of consumers. But Michael, given the role you played in financial reform after the last crisis, would love to hear your take on this as well.
Yeah, I do think that progress on central bank digital currencies could really improve the government's delivery system. It's one channel potentially that should be explored much more carefully and closely. I would love to see us make progress even within the existing system. There's so much that we could do that we haven't done to expand access to financial services for low-income people, to make bank accounts safe and affordable, to reduce the costs of transactions, to reduce the kind of gotcha fees that are involved in many bank accounts, the contingent fees, overdraft fees, insufficient fund fees, to make good funds available immediately, to reduce the need to use overdraft or payday loans or other expensive items. And lastly, a topic we haven't really touched on yet, and that's control of one's own financial data. We have a system right now where it's extremely hard for consumers to use the information that is really about their own transactions, to be able to switch accounts, to dump their bank account when they're not being treated right, to switch to an account that would treat them better. And better competition in this marketplace could drive down costs and improve services for low-income households. So I'd love to see progress on all these fronts using technological advances. I know we only have about a minute or two left. Maybe we'll each say just 30 seconds on, there's been so much movement in the last even few months on central bank digital currency. What do you all see as the future? If you had to just pull out 5 years from now and say, what does the landscape look like? Who's come out of the box with aggressive action here? What does the competitive space look like? Try and put yourself in the position 5 years from now. What did the last 5 years look like? Where should we be going next? And I promise I'll say mine as well. But Adrienne, do you want to start us off, and then Lev?
Sure. I mean, I think as has been the case with technology generally over the last decade, we're just going to continue to see an acceleration in the development of this technology and CBDC. And so we'll see more countries come online with their R&D and full implementation of CBDC. I think we'll continue to see, as we've seen with Singapore and Canada, lots of partnership and experimentation about CBDC and how it relates to cross-border payments. And I think we're just going to continue to see the payments landscape generally continue to innovate and have enhanced competition so that consumers have more and more options. And I think to your point, Michael, hopefully the acceleration with digital currency will be coupled with advances in how we think about consumer data, allowing consumers to really exercise that choice about where they get their financial services needs met, but also about their ability to make good financial decisions for themselves.
I'll just add that the one thing I'll just add that the one thing I feel fairly confident in predicting is that 5 years from now, the digital yuan will be the dominant currency within China and possibly have spread to many other countries in the Asia Pacific area. I think that with respect to the rest of the world, the next year is going to tell us a lot, and that this time next year, we'll be able to predict much more accurately what other countries are going to do about the rise of the digital yuan and how they are going to handle the transition to potentially introducing their own CBDCs.
Thanks, Lev. I do think it's going to be a fascinating time. I think the pressure from China and the pressure from the rise of private cryptocurrencies is really going to force both the US and Europe to be serious about a central bank digital currency. What form that'll take, how it'll get rolled out, who would be involved, I don't know. Those are super hard questions to be determined. But I do worry that if the United States is not taking this issue seriously, that we could see either a rise of a digital currency in China that is providing real competition for the United States, or the rise of the use of private cryptocurrencies that I think pose significant systemic risks in the event that a crisis were to occur, or the difficulty in that private cryptocurrency, would governments around the world be forced to step in? So I think that both those pressures are going to force a significant change in the future. Well, our time's up. This has been a delightful conversation. It's great seeing you, Adrienne and Lev, again. And thanks to all of our audience for joining us. And I hope you're enjoying the entire conference.
Thank you.
Good morning, good afternoon, good evening, whatever time zone you are in. Let me start by introducing our esteemed moderator for this panel on institutional digital asset adoption. Zoe Cruz is going to moderate the panel. She's no stranger to financial markets. She's had over 4 decades of markets experience, always from a capital flows perspective. Zoe Cruz had a 25-year tenure at Morgan Stanley. She was co-president there from 2005 to 2007. She was responsible for running major revenue-generating businesses, including overseeing their securities risk management and information technology. Prior to becoming co-president of Morgan Stanley, Zoe was the global head of fixed income, commodities and foreign exchange from 2001 until 2005. She joined the company in 1982 and was the 3rd founding member of the Foreign Exchange Trading Group. Most recently, Zoe was the founder of an investment management firm, Boris Capital Management, senior advisor at Promontory Financial Group, and is the founder and CEO of EOZ Global, a single-family office. She's also a strategic advisor to Ripple. Zoe, all yours.
Okay, thank you very much, Rina. I'm very honored to introduce the 3 panelists today. Dr. Rina Agarwal is the director of Georgetown Center for Financial Markets and Policy and professor of finance at Georgetown University. She specializes in global financial markets as well as governance. And she had various positions, including interim dean and deputy dean of Georgetown's McDonough School of Business, visiting professor of finance at MIT, and she's been involved with various activities around the globe that further governance on a global scale. Professor Jim Angel is an associate professor at the McDonough School of Business. Professor Angel specializes in the market structure and regulation of global financial markets, a very important field, as you might guess. And he has visited over 70 financial exchanges around the world. He has also served as a visiting academic fellow in residence at the NASDAQ, now FINRA, yes, NASD, now FINRA, and also as a visiting economist at the Shanghai Stock Exchange. Dr. Silvia Bertolucci is a lecturer at University College London. Her research focuses on the intersection of financial markets and cryptocurrencies, which is a very hot topical field, as you can also imagine. She has authored research on the impact of development practices on cryptocurrency prices and the Lightning Network. She's been a highly engaged Ubri researcher, and we're looking very forward to hearing from her and the other 2 on this panel. So with that, I guess I will begin before I ask a couple of questions of the panel to give you a few minutes of my macro thoughts on the world, given the fact that I had a front seat in the last 4 decades of global finance. I got out of business school in 1982 and joined Morgan Stanley, which at the time was a private company. It had 2,000 people and it had 3 offices, Tokyo, London, New York. When I left in 2007, it was 60,000 people. It had offices everywhere, and obviously it witnessed a torrential growth in cross-border capital flows. That growth, as I've said, in terms of the torrential growth thereof, when I started in the business of global finance, the stocks and bonds globally, public stocks and bonds, were $12 trillion. And now it's a hair under $200 trillion. In 82, the risk-free rate of return of government bonds, 30-year treasuries, were 14%. And as you know, right now, they're oscillating slightly above 0. The basic framework on which how you allocate assets across a portfolio stayed pretty much the same. 60-40, 40-60 if you were not as positive on bonds, a few other diversifier assets. But for the 4 decades of this tremendous change, portfolio allocation theory has been using pretty much the same framework. So that framework that still exists today basically assumes a few very important things: that stocks and bonds are negatively correlated with each other, that both are agents of free markets, how you value them are agents of free markets. Inflation rates will stay low for longer, and rates, obviously, as a result, will stay low for longer. So in this backdrop of the biggest bond bull market, fixed income bull market in history, 100 trillion of those bonds that I've mentioned earlier, 80% of those bonds return 0 to negative real rates of return. And the 90 trillion of the stock portfolio is in extreme bubble category by any measure that we've used in the past. The last time it was in this territory was in 1929 and in the year 2001. We all know what happened then. The final point I will make is that there's also regime change now in terms of fiscal policy. Was used to restart economies in the short term. So you basically had a very aggressive fiscal policy as a short-term lever to basically stimulate short-term demand. We are now talking about trillions, multi-trillion-dollar fiscal policy pursued to solve much longer-term issues, such as possibly recurring pandemics and possibly disastrous climate changes. We're talking about multi-trillion-dollar programs going for both of those things. So when you have unprecedented leverage that results in misallocation of capital that results from 0 to negative hurdle rates, and you have 0 to negative growth, which is where what we have now, I don't need to say anyone to this panel or to the audience that you don't need to predict a crisis, financial crisis, but you certainly can say unequivocally the probability of a financial crisis is rising exponentially. Before I start basically with the questions, given this macro environment, I will say my experience in Morgan Stanley in 05 and 06, people lost their jobs, their careers were hurt by being negative on US mortgages. And if you remember, up until 07, equities were making new highs. So I don't know if this is 05, 06, or 07, but we are in that zip code. So given this macro environment, how do you think digital assets fit into the portfolio of a large institutional manager? And I'll begin with you, Jim.
Well, thank you for asking. Now, one thing to remember is large institutional managers are very bureaucratic, very inertial. They want to see a long track record, and they want to see other people go first. They're going to wait for the early adopters to show performance. But when we think about digital assets, there are really 3 categories. You've got security tokens that I think will take off as a function of the underlying value created by those companies. We've got utility tokens you can do things with, and payment tokens, which are basically pitched as a store of value, as a hedge against collapse. Well, the problem is hedging is costly. When you buy insurance, it only pays off in that catastrophic situation. Under most normal conditions that you hope are not happening, they don't pay off. So, and I think the more intelligent institutional investors realize this. So, unless they really need that hedge for that catastrophic situation, they're going to step back. So remember, hedge assets are costly.
Okay. Rena, what do you have to add to that?
Yeah, so Zoe, thank you for laying out the macro conditions right now, which are pretty unique in many different ways. And before I start answering your question, the issue that you raised, I just want to thank Ripple and Ubri and Ubri Connect for bringing us together and getting different universities and partners to be working with each other. So thank you, Lauren and the team, for putting on a fantastic program here. Right? So going back to the issue that you raised, Zoe, I think especially in this environment that we are in, investors are really looking for non-traditional assets to include in their portfolios. And digital assets have certain qualities, right? They are similar to maybe like gold. They are divisible, they're durable, they're fungible, they hold value. And then there's another unique aspect that there's limited supply of these assets. And as Jim said, people are waiting to see if the other person go first, and then we'll get on the bandwagon. And that's starting to happen. And I think as, for example, the CME group now has futures and options. As these new kinds of contracts are introduced, and you have the Fidelities and the JP Morgans and the Goldmans of the world starting to get a little bit more comfortable with these assets. Now, we just saw the announcement that Square is holding a significant amount of Bitcoin on their balance sheet. I think all of these factors are really leading to investors including these assets in their portfolio. However, so you talked about the trillions in the financial markets. The market cap of these digital assets, it's still tiny. It's pretty small. Okay.
Yes.
I'll
And
stop
Sylvia?
that.
Yes.
Yes, thank you. So I also agree with Rena and Jim that there are significant frictions for investors to approach this space. Although it is true that assets are making their way into the portfolio of large institutional investors, family offices, high net worth individuals, but in different forms. So from very simple types of investment, like buying crypto from exchanges, to more sophisticated vehicles. We can think of crypto indices or tokenization of the equity of blockchain companies, for example. It is also true that most investors tend to choose Bitcoin, which is the oldest and most trustworthy, in a way, currency. There's been a recent survey of investors who, among those, about 25% chose Bitcoin as their investment. But going back to Rena and Jim's point, because of the uncertainty and the future evolution of this sector, there is indeed, in my opinion, like a benefit into diversifying not only the portfolio in terms of crypto and non-crypto assets, but also diversifying within the portfolio of crypto assets. So, for instance, to include the top performing assets that can be characterized by their market capitalization, their number of transactions, and many other measures that are used. Research in this area is looking precisely at how to create an optimal composition of this portfolio, how to rank dynamically the digital asset based on their performances, and how the risk return essentially varies by changing the basket of crypto. How much the portfolio should be crypto? Well, this is a matter of the risk profile of the investors, but investors expect to have at least 1% of their portfolio in the next couple of years made of digital assets.
Well, that's a very important point considering the numbers we were talking about, because even at 1% of $190 trillion, you're talking about $2 trillion flying out into, as Rena mentioned earlier, into very small cap kind of cryptocurrencies. So the diversification of portfolios, the first, in my experience, what we're seeing The first step was gold as a hedge against possible inflation. Finite numbers, because if you're printing fiat currencies, you know, I've gone back to reread books on the Weimar Republic, on the great crash of 29, and it's kind of scary how history certainly rhymes. So the first exodus is into gold, into copper and silver. And now a decentralized finance, as you've mentioned, is the new thing. And within that, as you say, I know there is a lot of great work that's being done. Once you decide to go into the cryptocurrency world, what is a diversified portfolio? So you don't pick a winner, you think it's a winner, but it may end up being the Netscape of the winner back in 2000. So how do you avoid that is by having a diversified portfolio. So Fidelity actually is very active in the space, as you all know, best-in-class institutional investor. They conducted a survey recently of 800 institutional investors and found some pretty earth-shaking statistics, I would say. 74% of US investors, 82% of European investors find digital assets appealing, at least to consider. Of those, 27% in the US and 45% in Europe, they're currently invested in digital assets already. Why do you think the European investors are leaning more aggressively in this massive trend than the US investors at the moment? So Sylvia, let's begin with you.
Yes, thanks. So I would like to start by adding maybe a positive note to this data by saying that already from 2018 to 2019, the proportion of investors in the US with a positive perception of this digital assets already increased by more than 8%. So I guess this is a good number telling us that something is moving, and also rather quickly also in the US ecosystems. Going back to the sort of difference between Europe and US, it is true that in Europe there are countries such as Switzerland with its well-known crypto valley ecosystems. We have Luxembourg, we have Malta, which has recently attracted a large share of the digital asset industry, especially that connected to the gaming industry. And all those countries essentially have moved forward to develop progressive and accommodating framework that are essentially helping companies in the space to flourish. Just by a final example, which is more local, here in the UK, between 2018 and 2019, the Financial Conduct Authority sort of started a public consultation with academics, with stakeholders in the space. That led to the creation of guidance and taxonomy of digital asset. Of course, this is not the final regulation that will be drawn on digital asset, but it was certainly very useful to reduce ambiguity within the sector and encourage investors to approach it as well.
Mm-hmm. Yeah. Rina, do you have anything to add to that?
Yeah, so I would echo what Sylvia said in terms of sort of the regulatory structure. So in the US, we do have a very strong regulatory structure, which is very good for the long run, but it's a complex structure. It's very fragmented, right? So not only digital assets and crypto, but in general, I would say fintech has made a lot of progress in other countries. Faster. There's a lot more going on, whether it's the peer-to-peer lending or it's a digital wallet. You see certainly Europe, you also see Asia, where a lot more progress has been made. So I think the regulatory issues are one of the issues.
We lost you, actually. I don't know. Can the rest? Now I can. Yeah,
well,
you came back. No, can't hear you. Sorry, Rena. Can the rest of you hear Rena? Is it just me?
I can't hear Rena, but let me emphasize
Okay.
what Rena was saying and say it still more forcefully. You know, in the United States, we have serious problems with our regulatory structure. It's not just fragmented, it's obsolete and dysfunctional. And it's leading to some serious problems, you know, which is why we're getting behind in this very important new technology.
Yeah. It's a real issue. And before we move to the next question, I would say it's a very, very important issue. I'm a huge believer in regulation, because I think after 1929, the crash of 29, it took decades of great thinking in regulatory frameworks that created the deepest, most transparent market in the world, the US equity markets. So I do believe this is a very important thing that we get right for the next 40 years, as the previous regulators had done in the last three, 4 decades. So moving on to, I know we're running out of time here, but what do you think are the barriers to invest still out there? Because obviously the barriers are coming down for institutional investors to invest in digital assets. And are they different between US and Europe? We got a flavor for that. But what are the barriers maybe globally still? And let's begin with you, Rena.
Yes, so a couple of things. I know we'll run out of time. So one issue is the whole price discovery mechanism, right? Anytime there are new assets, it tends to happen that you're not sure what to trust and what not to trust. So for example, the secondary market activity in these digital assets, there are more than 200 exchanges and they're not regulated, and there are concerns about face volume. So that's one issue. Another issue is, I think people are still struggling. We're trying to figure out how do you determine the fundamental value of these assets, right? What does that depend on? Then there are issues about institutional investors need custody. They need prime brokerage services for these products. And these are starting to develop, but are not quite there yet. So all of this about price discovery, manipulation, secondary market, and the associated services, these need to come up to speed for the market to take off.
Yes, yes. So Sylvia, do you have anything to add to that?
Yes, I do also. I agree with Rena that, of course, the evaluation is an important point here. In particular, we really need a robust and tested framework for digital asset. I do believe that if we are able to answer questions, some questions related to what are the real drivers of the adoption and the value of digital assets, then investors will be encouraged to enter this space of investments. And of course, the important question are whether this value comes from, for instance, the use case digital assets are designed for, or whether it's driven by the intrinsic features of the assets. For instance, is a digital asset that is based on a more secure underlying cryptographic protocol more valuable than other. So I think that if we're able to answer this question, we will encourage more investment in this space. Right. In terms of Europe, I guess that despite all this uncertainty, as you said at the beginning, Zoe, the prevalence of negative yield rates sort of makes still the digital asset a good protection from wealth erosion and an alternative to standard investment.
So just on that point, we'll leave 5 minutes for Q&A. I understand. Sorry, Jim, go ahead, please.
Oh, I just wanted to add one more point, and that is custody. You know, how do you prove to your investment committee or to your auditors that you actually have custody of a particular digital asset? How do you prove that you're the only one who has those digital keys and no one else has it? So this is a big sticking point for a lot of institutional investors.
Yeah, so that's the optimistic point, that there is literally hundreds of millions of dollars that are going into building the ecosystem, custody being one. As you know, Fidelity is building one. There are financiers from the regulated world that are running custody businesses that are actually best in class. It's beginning. It hasn't stopped yet. But on that point, I feel that there will be a catch-up between the mountains of money are looking for a home. The ecosystem is behind it, as you guys have alluded to it. But when I think of all the investments that are going, real VC investments that are going into building the ecosystem, I think it will happen. It's a matter of time. So on that point, I understand from all three of you are basically writing a book on investments and asset allocation from traditional portfolio into this cryptocurrency world. Do you care to share a little bit more about that seminal book? I'm sure there'll be a lot of us that are interested to read it.
Again, it's been terrific where Ubri has brought different universities together. So Georgetown is working with the University College London, Sylvia and her team, and with Ubri. And really the focus of the book is going to be all the things we've talked about in this panel. It's about pricing, it's about valuation, allocation, regulation. And we're hoping this book will be published in 2021. And the information about the book, if you're interested in contributing a chapter, you can find the information on our respective websites. But Sylvia, do you want to add something more on that?
Well, I think, as you said, we would like to stimulate a dialogue within the community. So we really much look forward to your contribution too. We will share a link to our call for chapters in the chat later. And I would like to finally thank Ubri, Ripple, and Georgetown for this amazing collaboration. We are really excited at UCL about this book. Mm-hmm. Thanks.
Okay, since there are no questions on... So there is a question from the audience that said, in the risk-on event in March 2020, investors dumped stocks, gold, and cryptos. When we switched to risk-on, I guess the issue is, if they're all correlated, the risk-on trade, where is the diversifier? I think that's a fair question. I'd love to hear your view, but I would take a cut at answering this way. Correlations are extremely unstable over short periods of time. And I would say 3 to 6 months to a year, that's unstable. But over longer periods of time, actually, they do work. And I would say the basic thesis why they're negatively correlated to me is the fact that these are finite. All the cryptocurrencies, the major cryptocurrencies, are finite in nature, as opposed to fiat currencies. You can print trillions, and whether you're in the 20s, where the Deutschmark was fine, and then it wasn't, it was binary. And in the US, the dollar, I think, is in a long, protracted decline. Within that, you have dollar going down, going up. So I wouldn't take the last 3 months of risk-on, risk-off cryptos behaving the way traditional assets are behaving as the predictor of the future. I don't know if any of you have something to add or something different to add.
Yes, so Zoya, I think you're absolutely right. Research has shown that during periods of severe crisis or issues in the market, the correlation tends to become higher. But then in the long run, the correlation might still be low correlation. So it wasn't surprising to see that everything went down, but then now they're following different paths.
Yeah. So I have 1 minute remaining. So if anyone in that minute wants to add something to that, that's a very, very important question to answer, but I guess we can always come back.
Yeah, I'm happy to add to that. I mean, what basically happened in March was, everyone's discount rates went through the roof because of the uncertainty. So the present value of everything went down. At other times, we have shocks that affect growth rates for stocks and bonds and cryptos differently. And so that's one of the reasons why short-term correlations are unstable, because the different shocks affect things in different ways. when something affects the discount rate universally, you expect everything to be positively correlated. Which is why when in a crisis, we say all correlations go to 1.
Exactly. Well, thank you so much, all three of you. And I hope to see you soon and in person. Take care. Bye-bye.
Thank you.
My name is David Schwartz. I'm the CTO at Ripple. I'm going to be talking about the XRP ledger, PayID, and the Internet of Value. Let me start by telling you a little bit about Ripple, the company I work for. We were founded in 2012. We have about 450 employees around the world, different offices. And we're an enterprise blockchain-based company. We provide solutions primarily for cross-border payments. Our customers are primarily banks and financial institutions. They use our software to make payments, primarily international payments. Many of our customers start with xCurrent for connectivity, but they're increasingly adopting our xRapid product to solve the pre-funding problem with on-demand liquidity. Our vision is the Internet of Value, enabling the world to move value like information moves today. That's a little bit abstract, so we try to describe our mission in slightly more concrete terms as enabling payments everywhere, every way, for everyone. And the way I like people to think about that is to think about how easy email is. You get somebody's email address and you can just communicate with them. It just works. And if any of you have made an international payment, you know that it is the very opposite of that level of convenience. We have the internet, we have easy shipment of physical goods, we have easy exchange of data, but payments are still stuck in the past. Our mission is to bring payments into that seamless future. The technology that we're using is blockchain, and I want to talk a little bit about where blockchain is and where it came from. And an analogy I like to use is the Ford Model T. The Ford Model T was a technological breakthrough, but it didn't have anything magic. There wasn't any there wasn't some new laws of physics. It wasn't like nuclear power. It was a clever combination of existing parts. It was incremental improvements in things like engines, in terms of things like suspension, tires. There was small bits of innovation in all of those things, and Henry Ford combined them into a single product. And in the Model T stage, interesting things happen. There are skeptics and there are visionaries. People will start to ask, could the automobile replace the horse? And it would make sense for people to say, well, that's crazy. We use horses for everything, and the automobile is like this niche product. It's expensive, it can only go on paved surfaces, and there are all these limitations. But what you have to look at is, what are the new technology's advantages? What does it do better than the previous technology? When you look at the limitations of the new technology, the question to ask yourself is, are those limitations fundamental, or can we get around them? The Ford Model T needed an oil change every 250 miles. That's not particularly convenient. But that's not a fundamental limitation of the automobile. That's a limitation of the Model T. And then what you have to ask is, what are we missing? What do we need for the Model T or its descendants to replace the horse? We need roads, we need gas stations, we need mechanics, we need technological improvements. And this is the stage where visionaries will start to look at a new technology and say, can this make a major impact? And of course, most of the time, those who say that a technology will make a major impact will be wrong. Most technologies don't make a major impact, but obviously the shipping container, the internet, all did. And I think we'll show that blockchain will. So blockchain is in that state where it's starting to mature. I don't drive a Model T, and goods aren't delivered in Model Ts, right? Cars have specialized to trucks, vans, sports cars, aimed at different use cases. One size does not fit all. At the visionary stage, you might just have the Model T, and people will start imagining how extensions of that technology could solve their problems. But there has to be that maturity. And that's where we are with blockchain right now. Right now, we have different applications like payments, decentralized finance, trade finance, equities settlement, gosh, even flower freshness. I mean, you name it, someone's trying to do it with blockchain. And obviously some of those things are not going to be good fits, as commonly happens with many technologies. People try to apply the new technology to literally every problem. Sometimes that works. The internet can be applied to almost every problem, and of course sometimes it doesn't. But that's the stage that we're in now. That's where blockchain is. We're in that stage where the people who have the vision to see blockchain potentially as replacing a large number of existing technologies or even enabling new use cases and capabilities, are trying to mature the technology to solve the real world problems. So what is blockchain? What's special about it? What I discovered when I started looking at blockchain in 2011 is that blockchains have certain characteristics that make them special. And the three that I think are the most important are system state is public, system rules are broadly enforced, and they're fault tolerant through simplicity by design. And I want to clarify what I mean by all of those points, because every one of them is important. By system state is public, I mean that the entire state of the system is accessible to anybody who needs to interact with the system. So what that means is if you want to interact with Bitcoin, you can see every account's Bitcoin balance. That information is entirely public. System rules being broadly enforced means that anybody who wants to interact with the Bitcoin system can enforce all of the system's rules. The system has certain rules. You can't create Bitcoin out of nowhere. There's a certain block reward. You need to sign a transaction to move Bitcoin. And those rules aren't enforced by some central system operator. They're enforced by everyone. And importantly, the fault tolerance is through simplicity by design. We have fault tolerant systems like the electric grid, for example, or even many conventional databases. But their fault tolerance comes from complexity. The electric grid is managed, there's excess capacity, there's balancing that goes on. It's very complex. And the problem with complex fault tolerance is you have complex failure modes. They're very good at handling what I would call a normal failure, where one component doesn't do what it's supposed to do and just stops doing things. But they have great difficulty with abnormal failure modes. Like, for example, a conventional database might have a fault mode where both a primary and a secondary or backup database system think that the other one has failed, and so they're in a dual active state, which is not tolerated well by the system. Blockchains have fault tolerance through design simplicity and through broad enforcement of system rules. No party can violate the rules because every party enforces it, so many failure modes are just structurally impossible. If the question is, what is blockchain's secret sauce? I believe it's those three things, and I think that's why blockchains are so reliable. Digital currencies were blockchain's first use case. The first blockchains were built for digital currencies. Bitcoin, the first blockchain, was built for Bitcoin, the digital currency. In fact, it created a lot of confusion in that people failed to realize that those were two different things. Bitcoin is an asset, it's a payment system, and those are logically distinct. And other use cases have been built on top of those chains. So this is an interesting point. Ethereum built on top of a digital currency, Ether, and then layered smart contracts on top of that. But this is a historical accident. In theory, a digital currency is an application for a blockchain or an application for a decentralized ledger system. And in an ideal world, we would have just built blockchains first as decentralized database systems, and then digital currencies would have been one application that could have been layered on top of them along with other applications. That didn't happen due to a historical accident. And I think there's great value in sort of rebuilding blockchains from first principles, forgetting about digital currencies so that they can tackle other use cases that involve online transaction processing and that can benefit from things like having the system rules being enforced and the better resilience against failure modes. So digital currencies are built on blockchains. They inherit the fact that state and rules are public and all participants can enforce rules, but they have another interesting attribute that you don't have to do this in blockchain, but digital currencies do this. There are no system administrative functions. There's nobody who has special authorization to modify the system. Changes to system rules or abnormal transitions that don't follow the system's rules notionally require the consent of literally every single participant in the ecosystem. So for example, if you want to change the maximum number of Bitcoins from a little over 21 million to say 30 million, literally every Bitcoin participant has to agree to that change or they will not be affected by it. Now, of course, in practice, if 90% of them agree to the change, the other 10% won't have much choice. They would be in their own little island. But at least notionally, until that 10% agrees to that change will not affect them. So they're governed by they're brutally democratic, essentially. There are not authorized system administrators, and that's an important attribute of digital currencies, and it makes them different from all previous assets except maybe physical cash. XRP, the digital asset that I worked on developing, we think is the digital asset for payments. We built it for payments. In particular, the settlement time is much quicker, just a couple of seconds. The fees are much lower, the throughput is higher, energy consumption is lower. It's been operating for something like 8 years now without any significant difficulties. And it uses, instead of proof of work, it uses a federated Byzantine agreement algorithm that we called consensus, which provides better predictability. And I think that's important. You want fees to be stable. The fees in many other systems are widely varying, and you want settlement time to be stable. That 3 to 7 seconds is partially system variation, but it's also just this question of how you measure time. Do you measure it from when a transaction is formed, from when it's accepted? And not necessarily to get into the details, but it's a fairly consistent settlement time. You can be very highly assured that your transaction will settle within 7 seconds if you pay even a pretty minimal fee. And that's something that most other blockchains don't have. And I think that's important in the payments use case where reliability and stability are fundamental. Here you can see a chart comparing XRP's performance to the performance of other major digital assets, and you can see that in those attributes like security, speed, cost, consistency, XRP is a real winner, and that's why we think it is the best digital asset for payments. Over 58 million ledgers have closed roughly today, about every 5 seconds. Initially it was a little slower because demand was lower. And XRP is easily available on over 140 exchanges, so it's not difficult for someone to acquire XRP or convert it back into fiat if that's what they want to do. I want to talk about some of the XRP ledger innovations because I'm very proud of them, and I think it's also important to understand the technological innovation that's gone on behind the XRP ledger. So one thing is its federated Byzantine agreement algorithm. I know people kind of forget about this today, but back in 2011 when we started working on it, there was a belief that proof of work was Bitcoin's secret sauce rather than those things I talked about transaction state being public, systems rules being broadly enforced, lack of administrative functions, and so on. But what we realized was that proof of work was just the solution to the double spend problem. It wasn't key, and in fact, it was one of the things that made Bitcoin both slow and expensive, and it actually doesn't decentralize because people who can mine efficiently tend to look similar. And so it actually is a centralizing tendency that the other stakeholders have to work against. Another important thing is that transactions operate on views, and views are checked for invariant violations. This is a very significant technological innovation. It improves performance, but the main thing it does is it improves security. I'll give you an example of how to think about that. Imagine if someone said to me, hey, David, how do you know that someone can't just submit a transaction that creates a whole bunch of new XRP? That would obviously be very bad. Without these innovations, what I would have to say to them is, well, look at the code, and if you find a way for somebody to create new XRP, tell me, and we'll urgently fix it. But we believe that we've gone over the code, and there is no way to create XRP. By design, there's no way, and unless there's some kind of bug, it shouldn't be possible. The problem is there's tens of thousands of lines of code you have to look through, and there's other problems than just a transaction creating XRP. Accounts, you could imagine transactions that do other things that are not supposed to happen. Maybe they make payments incorrectly, or they do other things that are not supposed to happen. So what the XRP ledger does is it executes the transaction in a scratch pad that we call a view, and then it analyzes that view. It's very trivial, just a couple lines of code to say, does this set of changes to the ledger create XRP? You just add up the XRP before the view, add up the XRP after the view, and see if it's higher. What the invariant checker does is if any of those invariants are violated by the view is thrown away. It never gets applied to the live ledger. And a new view is inserted that says this transaction broke a system rule. Now that has never happened, that such an entry has never appeared in the public XRP ledger, but obviously if it ever did, we would know that there was a bug in the code. So unless you found a bug in the invariant checker, which is a very small piece of code compared to the XRP ledger, it's not possible to create XRP because any transaction that does so would just be rejected by the invariant checker. And of course then we would diligently analyze that transaction to find and fix the bug, but at no time would it be able to create XRP in the public ledger. I think that's a critical innovation. Consensus is the way that we advance the ledger, and I want to share a little bit about how we came to that. When I first started working on this, proof of work was believed to be the secret sauce, and it seemed like an intractable problem. It seemed like there was no way to advance the ledger in ways that people agree upon. And the core problem is the double spend problem, that a single person could send the same asset in 2 different places, and people need to agree on which of those transactions is valid. Otherwise, you can never rely on a payment. And what we realize is that all you have to do to solve the double spend problem is put transactions in a global order. If there are 2 transactions that try to send the same asset to 2 different places, if we agree which one's first, we can agree that the second one is invalid because the asset is no longer the sender's asset. So it just requires global transaction ordering. And it turns out global transaction ordering is not that difficult because transactions are just numbers, and numbers are very easy to sort. So we developed a couple of principles, 3 principles that permit systems to agree on global ordering. And one principle is, if a transaction has no reason not to be included, all honest nodes will want to include it already. There's no problem to solve. All honest system participants will say this transaction has no reason not to be executed in this block. Let's execute it in this block. They'll all sort it the same way, because sorting is something that honest people should be able to agree on. It's just putting things in numerical order. If a transaction has any reason not to be included, it's perfectly fine not to include it. Let's say a transaction arrived very late, and maybe some people think it arrived too late to go in this block. Or let's say a transaction is part of a double spend attempt. If someone does a double spend attempt, it's perfectly fine to say to them, we're not going to include your transaction right now because it's part of a double spend problem. So as long as there's any legitimate reason not to include a transaction, it's perfectly fine not to include it. So long as if a valid transaction that doesn't get into the consensus set goes into the next set. So let's say there's a transaction that's submitted and someone says, I don't think that transaction was submitted on time. I already decided not to include it in this block. It's perfectly fine for everybody to say, okay, we won't include that transaction in this block, but if it's valid, it definitely goes in the next block. That's fine. So basically you can say two things. Yes, put this transaction in this block, or no, put this transaction in the next block if it's valid. There's no way to say don't ever process this transaction or throw it away or execute a double spend. And once all participants agree on a block of transactions, they all sort it the same way, they all execute it the same way, they all get the same result. So it turns out consensus is actually remarkably robust because of these principles. I have to say I was surprised at how robust it was. The XRP ledger is not UTXO based. As some of you probably know, Bitcoin doesn't really think about accounts, it thinks about transactions. Accounts are primary objects on the XRP ledger and they have balances. This allows some very powerful features that are not possible on ledgers that aren't account-based. My favorite example is key rotation. So let's say you're a charity and you've published a ledger address for people to send contributions to, and you want to change who has control over that address. In a UTXO-based system like Bitcoin, you need a new address to do that. So you have to tell everybody to send their payments someplace else. On the XRP ledger, you can just change the key that signs for an account. So you can, if you use new infrastructure, you have new employees, you don't trust the old employees, you can just change the key. And you can also set up multi-signature accounts. You can set up multi-signature accounts on Bitcoin, but you can't manage the multi-sign. If one of the signers wants to rotate their key, they can't do it. And that also allows issued and accepted assets. We had stablecoins on the XRP ledger way back in 2012. Accounts can actually issue what are effectively IOUs. If you think about a bank balance, it's effectively an IOU from the bank. The XRP ledger supports a similar concept to allow assets to trade around that are backed in the real world. So the XRP ledger is not just XRP. It also has community credit features where you can allow other accounts to borrow money from you or owe you money. Non-XRP asset balances can exist between accounts, so it can keep track of obligations. Accounts can agree to owe each other funds. And debt settlement can be used as payment. I could spend a lot of time explaining this, but it's a super interesting way to allow, essentially, instead of me borrowing $10 from you and owing you $10, instead you and I exchange IOUs. So I owe you $10 and you owe me $10, and those IOUs can be used as assets to settle other payments. It's a fascinating technology that I would love to see more use of. We integrated a decentralized exchange way back in 2012. You can place offers to trade one asset for another. Payments can take the offers, and it has pathfinding and multi-path payments. So what multi-path payments mean, if you want to trade dollars for Bitcoin, you don't have to find somebody who wants to trade Bitcoin for dollars. You can, let's say, trade the dollars for XRP and the XRP for Bitcoin, and you can actually have a payment that instead of drawing one order book way down and having a terrible rate, can draw off multiple order books. It's a fascinating feature that we delivered in 2012. So digital currencies are great. Payments are not so great. Can digital currencies fix payments? Well, I think it helps to understand why payments aren't so great. Why is a payment not as simple as an email? Because payment networks are disconnected. Not only is there no universal namespace, there's no universal payment address or pay ID yet, like there is for email, but also the networks themselves are disconnected. If I have money in PayPal and I want to get money into Venmo, they're owned by the same company, they don't even interoperate. So there's no universal namespace, and the payment networks are disconnected and don't connect to each other. And as a result, global payments are slow expensive and unreliable. And part of why they're expensive is because if you need to use a whole bunch of different disconnected payment systems, you wind up having to leave money in each of those payment systems, which is very costly and inefficient. And any of you who've made international payments know that the reliability level is low. And worse, even when payments are successful, there's frequently no closed loop. So you wind up calling your bank to ask them if the payment succeeded when it actually did succeed, and you just didn't get that information because maybe the recipient didn't tell you. So that's not a good payment landscape for today's payment demands. New corporates need hundreds of payment engineers to integrate with multiple payment systems, and they have complex treasury operations to move money between those payment systems. Smaller competitors just can't do that. You know, Amazon, if you're Amazon or Airbnb or Uber, you can have hundreds of payment engineers who make sure that your payments meet your business requirements. But there's no way that a small competitor can build a business that can accept money globally efficiently. They can't get that real-time, low-cost settlement. They can't get that good experience. They can't get the absence of delays or failures, the things that those customers want. And blockchains don't solve that problem. Blockchains don't talk to existing payment systems. Blockchains don't talk to each other. We've invented a newer version of the interoperability problem with all of our digital assets. And I think we kind of got blindsided in the early days of Bitcoin. I think the strategy was everybody use Bitcoin for everything. Bitcoin works with Bitcoin, and so interoperability will be solved. But of course, that's incredibly naive. People have different requirements. They want different things out of payment systems. There isn't going to be one world asset. There isn't going to be one world payment system. And even if there was, you couldn't abandon all of the existing value. You would still need a way for people to get to that new system, and it would have to interoperate with existing systems for some overlap period. As some of you may know, one of the reasons that Cisco was so successful in the internet age was that they supported broad interoperability with technologies that other companies considered ancient. But that was what enabled them to grab a foothold, because when the internet is new and gaining market share, interoperability is key. You can't just imagine this future world where everybody uses Bitcoin, because you'll never get there without solving the interoperability problem. So digital currencies have to connect to existing value transfer systems, and they have to connect existing value transfer systems too. They have to act as a bridge, and they have to be bridged. That's what we need if we're going to get that internet of value that's our vision. We need banks to talk to blockchains, to talk to mobile money, to talk to online wallets. We need assets that are in common to chains. We need liquidity between the chains. It's an effort as big as building the internet, and it's going to solve our payment problems. Now, I want to talk a little bit about interoperability, which is what enables the internet of value. If we're not all, again, as I said, we're not all going to be on the same system, but even if we were on the same system, we need interoperability to get from where we are to that same system. So you need connections between payment systems that link both payments and assets. There's no way around interoperability. There's no other way to do it. Standardized protocols like Interledger and PayID are efforts in this direction. Again, looking at email, the universal namespace is critical, completely transform what mail is, just works, and then of course the physical interconnections between systems to enable the email to just work. So it is a two-step process. A universal namespace is one thing, but then you also need the connectivity, which requires interoperability protocols to make the namespace just work. A little update on the effort on PayID, which is a universal namespace for payments, 48 coalition members, over 125 million users. 7 out of the top 10 crypto wallets have joined the coalition. New members, you can see Coin Payments, Binance Australia, Atomic Wallet, AirTM. So that effort is moving forward to solve the universal namespace problem. Some new features in PayID include verifiable PayID, which allows users to sort of own their PayIDs rather than having them owned by providers, and some additional tools to make development and testing easier to do. I want to talk a little bit about one of the sort of aha moments that led to PayID, which is understanding that email is really two things. It's a universal namespace, and it's interconnectivity between different systems that enable that universal namespace to be useful. If you give me your email address, joe@foo.com, and I know that I now know how to tell foo.com your mail, but I have to be connected to foo.com. My email system has to be connected to your email system. There has to be a transfer standard. All of those things have to exist, and it's kind of a chicken and egg problem. And I think what we realized with PayID was that having the universal namespace first enables you to build those interconnections. And so it's an enabling technology to get to that world where payments work as easy as email. But it's half the problem. A universal namespace and sort of discovery is half the problem. The other half of the problem is the interoperability to make the actual funds able to move. So it's a critical enabling technology. There'll be benefits immediately, but it's not the end of the long-term vision of making payments work like email. It's a critical step on that path. I want to talk a little bit about micropayments because I'm a personal believer in them. Micropayments are kind of like the difference between packet switching and circuit switching. Maybe I'm dating myself a little bit here, but in the old days, you got a circuit for a phone call. You sort of owned a path from the beginning to the end. That's not how they work anymore. Phone calls are broken into packets, and those packets are switched. And I get questions like, well, what good is a micropayment? They're so small. Well, what good is a packet? It's so small. But I'm talking to you now because we have technology that can easily marshal millions of packets. And if one packet goes awry, it doesn't matter because the ends are smart. This is a critical aspect of enabling technology, smart ends and a dumb middle. The internet's pretty dumb. You just put a packet into it and maybe it comes out. It doesn't do anything fancy. It doesn't transform the data. That's good. That means that I'm talking to you now over technologies like Wi-Fi and video streaming that didn't exist when many of the routers that may be carrying this traffic existed. They'll still work because the middle doesn't have to be smart. All the smarts are at the end. That's what enables the innovation. And smart upper layers and dumb lower layers. Wi-Fi doesn't care what data you put over it. I mean, it's not literally dumb, obviously. Wi-Fi goes to extraordinary lengths to provide high throughput and great range, but that's what they should be working on, right? That's what a smart lower layer does. It shouldn't be focused on the stuff the upper layer. It shouldn't care why we're moving data or what the meaning of that data is. That should be in the upper layers. And the advantage of that is you can build a new upper layer for video streaming that will work over technologies like Ethernet that never had video streaming in mind. That's how you build interoperable networks, and that's what micropayments can do. That's kind of the vision that mostly that Interledger had. And there are interesting things with great micropayments. So you don't need quotes, options, or trust. If I'm going to convert dollars into euros and it's $1,000, I probably want a quote. And quotes create problems. First of all, you have to expect the party that gave you the quote to honor it. And then there's a sort of free option problem where I might get a quote and only use it if the market moves against you. So you have to give me a quote that protects you against market movements. But if you give me a not very good quote, but you're actually going to give me better service, it's very hard to compare. Right? Like if I call up 3 companies and I ask them how much something's going to cost me, and one says no more than 1,000, one says no more than 2,000, I'll probably go with the one that says no more than 1,000, but the one that said no more than 2,000 might actually be cheaper. They might just be more protecting themselves against possible, unforeseen events. So I can't make an intelligent decision without a hard quote. But if I get a hard quote, you're not going to get like a hard currency exchange quote valid into the future that's very good because the market might move against them. All of those problems go away with micropayments. If I'm moving 1,000th of a penny, I'll just send the 1,000th of a penny and see how much comes out the other end. And if I don't like the rate, I just won't use that path again. I'll just use other paths. I can marshal millions of them, and it supports that same innovation above and below. Just like the internet allowed innovation above with like streaming video and new protocols, and innovation below like Wi-Fi and cellular technologies that didn't exist when the middle was developed, it separates those layers so that there can be innovation all around. In this case, above would be new protocols for paying, like paying for content, paying for goods, streaming payment to pay for streamed content. And innovation below would mean things like new blockchains and new ledgers. And if we design the system right, we can get that type of separation and innovation. The Interledger protocol is doing micropayments today. There have been over 1 billion ILP payments to date. In fact, way over 1 billion. There were 1 billion as of the beginning of 2020. The average payment is a tiny fraction of a penny. That's why there are so many of them. But payments can stream. So I can stream money at you as you stream content to me. And I think the first use case for micropayments is definitely going to be paying for content. It's a perfect fit, and paying for content works so badly all other ways. The usual way we pay for content today is ads, and ads are why companies have to violate my privacy. If you know my age, my gender, and where I live in the world, you can get more money for the ads that you show me, and that gives you the reason to violate my privacy. So it's a problem that's really worth solving, and micropayments are solving that problem today. So those are the pieces. We need digital assets, we need interoperability, maybe micropayments to get that Internet of Value, that world where a payment works as easily as an email. We need a lot of more research. This is a nascent field. A lot of the things I'm talking about are theoretical. Some of the things are here today, and some of the things I'm confident we can build in the future. But we're in that visionary stage where you're looking at the Model T and you're just starting to see that diversification. We need quantum-resistant cryptography. We know quantum computing is going to be here eventually, and it breaks a lot of the cryptography that we have. There are quantum-resistant signature algorithms that we could use today, but they're not good for blockchain, and being forced to use them would really suck. So we need breakthroughs in quantum-resistant cryptography and algorithms that work for blockchains. Zero-knowledge proofs are a brand new cryptographic primitive, incredibly exciting area. We need to figure out what they're good for and how to use them, and we need more technological breakthroughs in improving their performance and compacting their size. It's a fascinating area of research. Governance is an interesting area too. How do you govern a system that works only by the continuous agreement of its participants? They're very much like governments and much less like corporations, and almost literally everything else. I mean, this is a nascent field. We don't know what we're doing yet. We barely know how to do anything. We need innovation. I've talked about trustless bridges that will connect blockchains to each other so assets can interoperate. We got to figure out what problems DeFi can solve. We have these DeFi technologies and we're not really sure. What can people actually use them for? Where is their product market fit? What can we use blockchains for beyond money? And again, almost literally everything else, whether it's computer science, whether it's history, whether it's economics, whether it's distributed systems, but also the governance problems, the sociology type problems. How can we change the world? Can we really make a dent in global finance? I think we can, but we are just very early and we need everything, and that's why this is such an exciting space to be in. Thank you.
All right, thank you, David, for that great talk. Lots of exciting stuff going on. We're very excited at BitPay about PayID in particular, and we're doing the work necessary to adopt that in our wallet and our platform as we speak. But I wanted to talk to you a little bit today about payments on a blockchain more broadly and in general. And so I'm Stephen Pear. I'm the co-founder and CEO of a company called BitPay. We were formed in 2011, so we're coming up on our 10-year anniversary next year. And what we do as a company is enable people to manage payments on a blockchain. So we provide all the tooling that one might need for e-commerce payments, invoicing, and et cetera, on our platform. And we help companies and individuals manage the full life cycle of a payment. And there's a lot of aspects of a payment that people often overlook. Things like, how do you manage a refund? How do you manage currency conversion in the middle of that? And so that's really what we're here to do, is to help those companies manage their blockchain payments. So our vision at BitPay is that all payments, or most payments in the future, will be done on a blockchain. And really, the reason we believe that is because blockchain itself is a new kind of database. If you compare it to old kind of databases where we have this repository of information that we try to protect through boundary defenses and make sure the wrong people can't access it, that's a very old school way and very insecure way of operating a database. With a blockchain database, rather than create boundary defenses to prevent bad actors from getting in, the database is open to the world, and anybody is free to mutate the state or modify that database as long as they follow the rules set forth for that blockchain. So, in the example of with Bitcoin, for example, the world's oldest blockchain, as long as you create a transaction that has no more Bitcoin coming out of that transaction than were put into that transaction, then and then it's properly cryptographically signed, and there are some other rules that go along with that, then you can create that transaction and you can broadcast it on the network, and then it will get incorporated into the history of that database. This is transformational, and we at BitPay actually think that blockchain as a database technology will become in the future the dominant form of databases that people use. So payments is one use case, but there are many use cases that blockchain can address. So it's that fundamental belief about blockchain as a database technology and its adoption, not just for payments, but all kinds of use cases, that makes us believe that in the future, most payments are going to be done on a blockchain. And our mission at BitPay is to build the best platform for companies and individuals to manage those payments and stay laser focused on that. So when we think about how blockchains are transforming payments, we can point to things like it's a digital transaction first and foremost. So we've moved out of the physical realm into the realm of cyberspace. It's convenient, it's ubiquitous, so it works anywhere you have internet access. And then it's safe and secure. And in fact, if you look at the Bitcoin blockchain, the oldest blockchain, it's a database whose integrity has never been compromised in the entire history of that database, and this despite it being open to the world. So that's really profound when you think about it. So the first use case that we like to talk about is sort of BitPay's bread and butter, and what we started out originally focusing on back in 2011, which were consumer payments. So you can imagine this might be somebody, you know, buying a computer from Newegg, who is one of our merchants. Bob can be, you know, sitting anywhere in the world that he has internet access, go to Newegg's website, choose the option to pay with cryptocurrency. And we do support many cryptocurrencies, including XRP on the BitPay platform, and make that payment happen. And Newegg receives that payment, and it's a very low cost transaction. It's immediate, and there's no risk of fraud or chargebacks, or very low risk of fraud. When you compare that with a traditional credit card payment, if it's an international transaction, about 1 in 50 of those are fraudulent, and the merchant has to pay the cost of that. But that's one example of how a consumer might use blockchain payments. But there are many other capabilities that we provide and ways that we give a consumer the ability to tap into their wealth that's stored on a blockchain, whether it's Bitcoin, XRP, or any of the other ones that we support. So you might buy a computer from Newegg, but another thing you can do is you can get the BitPay MasterCard and shop anywhere MasterCard is accepted. And with a single click of a button, convert your XRP or Bitcoin Cash or Ethereum or several others, including US dollar tokens, stable coins. You can convert that into a dollar balance on that MasterCard and then spend it wherever MasterCard is accepted. Now, hopefully, eventually, everywhere you want to spend it will eventually natively support a crypto payment. But we know right now, today, there are many businesses that don't yet support crypto payments. Another thing you can do is buy gift cards on the platform. And this, is just yet another convenient way for a consumer to tap into the wealth that they've, accumulated in cryptocurrency. And when you think about that, you look at all the blockchains. You can go to coinmarketcap.com, and you can look at all the top cryptocurrencies. And there's hundreds of billions of dollars that are stored in these blockchains. And as a company, we want to give those users very convenient means of tapping into that wealth and accessing that wealth. Another thing that consumers might be interested in is getting paid in crypto. So while BitPay is primarily known for our merchant services and our invoicing and billing, we also go the opposite direction. We allow companies to be able to disperse payments, so they can send us a traditional fiat payment, using a traditional bank transfer, and then tell us, okay, I want to pay all these people around the world in whatever cryptocurrency, and we will manage that whole process for them. So some use cases for that are affiliate programs where you have a company that needs to pay a lot of people around the world, and they need just a convenient place to do that. Another example might be your payroll. So a payroll company might use that to give employees to take a portion of their paycheck in crypto. So those are some of the examples of how a consumer might, can benefit from crypto payments. And by the way, I should stop since we're talking about Ripple and XRP. I will say that XRP is really one of our favorite payment platforms. And I say that because, since we've launched it, it's been, a very straightforward, very seamless, process from a back-end perspective. So, XRP transactions tend to go through, they get confirmed very quickly. And we've just generally had very little issues, very few issues with that blockchain. So I think XRP and the XRP blockchain is a really great blockchain for payments. And I just wanted to mention that since we're at a Ripple conference, but it's true. I mean, I think if you ask anybody working on the software at BitPay, we've been very pleasantly, and I would say pleasantly surprised with how straightforward, simple, and easy it's been, and how it really just works for that payment use case. All right, so the next thing I wanted to move on to are, business payments. In some ways, the consumer payments, really there we're talking about attracting and giving tools to that early crypto adopter that has some cryptocurrency in their wallet, and they just want a convenient way to spend it without sending it to an exchange, without cashing it out, having to withdraw to a bank account and use legacy methods of payment. We would rather they just simply spend that currency directly. And as a company, we want to enable that and just make that a very easy process for the consumer. But in some ways, even more compelling are the B2B or business payments. So think of an example like, a small company in Brazil, paying to, another business located in South Korea. If you look at the traditional ways to make that payment, you're often talking about, well, if you talk about a really, really traditional way, that Brazilian company might write a check and put it in the mail or FedEx it over to, that South Korean business. Now, the business sitting in South Korea has to look at that check and say, that's a check drawn on a bank in Brazil, not in South Korea. So how are they going to actually get that over into their bank account? And usually that method actually won't work. But if you talk about an electronic payment, such as a wire transfers use something called the correspondent banking system. And which means that it may be a small bank in Brazil that needs to connect into a bigger bank in Brazil that has ties into the Forex markets that can then have a correspondent bank located in South Korea, and they kind of have some trust between one another. And then that bank in South Korea might have a relationship with ultimately the bank that the business in South Korea uses. And so you got like 4 banks involved in that transaction. There's a lot of trust in that between those banks that has to be in place for that transaction to be able to go through. And they're each going to charge a fee. And it's going to take a while. And usually when you send a wire transfer like that, you don't actually know when it's going to arrive, and you don't even know how much you're going to end up paying for it. So it's really an antiquated system. If you look at a crypto transaction, when I transfer XRP from one person to another, or from one business to another, it's a digital asset that has a market value. And that possession, that ownership, that custody of that asset transfers immediately, like sending an email. And really, when Bitcoin was created back in 2011, that was the first time we had anything like that, any capability even remotely like that. I have a digital asset. I like to think of, Bitcoin and XRP as digital commodities. And that asset can be transferred from one person or business to another person or business across the world, wherever there's internet access, and it has a market value in both places. So the receiving company, it eliminates a huge amount of risk for the company receiving that payment, because they're not getting a check in the mail and they're not waiting on some wire transfer. They instantly get the asset and it has a market value. And if they choose to, they can go sell it in their local market and convert it into their local currency if they choose to do that. And many companies, in fact, do want to do that, both on the paying end and the receiving end, because their accounting systems are based in their local currency. And it eliminates a lot of accounting complexity if they can just transact and do their purchasing in that native currency or that local currency. Now, most business, you might be surprised to find that most businesses still use paper checks to pay each other. In fact, a recent study conducted last year showed that about 80% of businesses still use paper checks to pay each other. And only 15% use wire or ACH to do that. So there's still a tremendous opportunity, untapped market potential, almost untapped market potential to really bring those businesses into the modern era and give them tools that allow them to transact much more efficiently, much more safely. So I mentioned sort of payroll and disbursements. A couple other examples are, companies like Airbnb and Uber paying their hosts and drivers around the world. So you're talking about companies that have a very broad and very large workforce of really contract workers, and using cryptocurrency to make those payments happen. And whether you're talking about Bitcoin, XRP, or stable coins built, for or tied to the local currency, it's just easier, right? It's just easier for a company to tie into an API that BitPay can provide them, and they can just push those payments out and manage that whole process. Again, a lot of the, you can, physically execute these payments on the blockchain, but BitPay's business model here is really to, make that whole workflow easy on the company and really assist them in managing that. So you can imagine if you're having to pay, 1,000 different people and disperse that all over the world, having one API that you can tie into and just manage that whole list of recipients and make sure that all the payments go through, that any that go to a wrong address or whatnot, you have ways to deal with that. So that's really what we talk about when we mean the entire workflow of a payment. So, just to kind of summarize, crypto payments really eliminate friction. And in fact, if you use, our tools, we like to think, if you use our tools to manage those payments, it's really easy. Many people have not actually used a crypto payment or conducted a crypto payment, and they sort of assume that there's this complexity. And with a lot of tools there are, and when you talk about, using a different wallet from, the payment provider, from the exchange, there's a lot to wrap your head around, and it can be intimidating for the new user. And a lot of the companies in the space were really working hard to try and make it more approachable and easier to use. But I can honestly say that once you've actually gotten over the hurdle of, setting up a wallet and acquiring your first cryptocurrency, when it actually comes down to making that payment, it's extraordinarily simple. One of our customers, AT&T, you can actually go and pay your cell phone bill, your DirecTV bill, your internet bill, right from their website. You choose BitPay as a payment option. An invoice pops up. You choose which cryptocurrency you want to pay in. And then you scan it with your wallet and you click a button and you're done. It's really that simple. So obviously we're bullish on payments. The last thing I'll talk about is just sort of how we look at that new user into to the space. Somebody who has really never used cryptocurrency at all. They usually are starting out by hearing about, the price of this or that crypto, and they really want to make an investment. They're interested in, the gains that they see people making from those investments. And that's usually the starting point. And so what do? They go sign up for an exchange account and they buy their first cryptocurrency, but they're storing it on the exchange. So we kind of consider this the sort of fear of missing out user, the user that just wants some exposure to the asset for financial gains. Once they have that and they actually have gotten interested in it, then usually they want to take the next step. And this is usually where they decide, okay, leaving assets with accounts on exchanges or other services is not necessarily the best way to store your crypto. So in the community, a lot of people talk about not your keys, not your coins, right? And they're really trying to encourage people to take possession of their cryptocurrency. So for that, you need a wallet where you can actually withdraw from the exchange or wherever you have a crypto balance, withdraw it out of that account and put it into a wallet where you control the keys. And this is really where we're focusing our efforts, is once that user wants that wallet and to be able to secure their own crypto, we want to build tools that help them do that the right way, help them do that safely and securely, and really start to own their own crypto. Now, so that's the not your keys, not your coins phase. Now, the third phase is when people actually want to start to transact, and that's usually when they have seen some gains, and they do have some wealth now accumulated in that wallet. Now, everybody talks about, the sort of the Lambo meme. Now, not all of us are going to be so fortunate that we make that much money on crypto, but we actually call that third phase sort of the Lambo phase, and just kind of a funny little thing that we like to talk about. But it's really the phase where you want to start buying stuff, and so this is really where you've gotten to the point where people are now starting to conduct commerce with cryptocurrency. And so again, we're focused on that phase as well. So really giving people the tools to own their own crypto and then to enable them to spend it once they're ready to do that. And so, that's really it. To summarize, I think, we're really excited about some of the, partnering with Ripple. We're very excited about PayID. We think that'll solve a really important pain point, which is dealing with these low-level addresses in wallets. So you can look forward to BitPay adding support for that in the very near future. And we're looking forward to doing a lot of great things related to crypto payments and partnering with Ripple to do that. And there are great speakers coming up that I hope you'll stick around for. And I also hear that there's some great announcements coming from RippleX, so you'll want to stay tuned for that.
I'm Joey Krug. I'm co-CIO of Pantera Capital and one of the co-founders at Augur. And I'm going to give a talk on decentralized finance and sort of how I see the space, where I see it going, and what sort of interesting things and investments we're making in the space as well. So the main way I think about DeFi is sort of as this new financial infrastructure. It's really the underpinnings of a new financial infrastructure. If you think about the internet was the underpinnings of a new information infrastructure. The internet did kind of two things that was different than the information revolutions prior. One is that it revolutionized access to information, but two is that it also democratized creation of content. So if you look at radio, television, etc., the form factor was different, but for the most part, not very many people are on the radio, not very many people are on TV. But with the internet, the thing that was different is that anybody could really go out there and create a website or post a tweet, or even something as mundane as post a picture of what you had for dinner last night on Instagram. And if you told somebody 30 years ago that people would post pictures of the food that they had for dinner and their friends would comment on it and like it and kind of discuss it, that would have been viewed as really wacky and really crazy. So I'm sort of asking you to suspend your disbelief for a moment and envision what's the wacky, crazy thing like that, but for finance. What could actually happen here? And my belief is that similar things will happen for financial markets. People will basically create and use kind of new bespoke financial products on the fly. I don't think this will be that uncommon in the future. And so if you look at how the internet revolutionized information, I think blockchain tech is going to do the same thing for finance, particularly surrounding opening access to and enabling the creation of new financial instruments, contracts, and agreements. And so if you think about a financial system, the way we think about crypto is it's sort of this parallel financial system. You have the old one that still exists, and for a long time, you'll need to be able to get money back and forth between the two. And if you look at kind of what makes up a financial system, I believe there's really 5 key components. There's the unit of account. So this is, in plain English, it's, what currency are you trading in? For most people, that's dollars. If you're in Europe, maybe you're trading in euros. But there's only a handful of currencies that are really used for global trade. And in the blockchain space, while I'm sure a lot of people would love for Bitcoin to be this kind of global currency that everyone uses, I think that would be cool too. It's quite unlikely for a very long time. And so you need things that are dollar pegged assets. And so this is where stablecoins come in, things like USDC, things like DAI. There's a bunch of different variants of stablecoins, but the punchline is they enable you to have effectively dollars on the blockchain. So that's one kind of key primitive. The next one that's really important is decentralized exchanges. So the concept of how do you trade these assets without an intermediary? One of the big benefits of blockchain tech is cutting down on the amount of middlemen and kind of removing unnecessary people who siphon a piece of every transaction. And so with exchanges, that's kind of another component. Decentralized exchanges allow trading of these assets with no intermediary. Right now, it's primarily just cryptocurrencies, but long-term, you can envision people trading a wide array of assets. You can envision, tokenized securities on the blockchain. You can envision people trading, fractional pieces of real estate. That's another key component. The last 3 components are, they're not strictly necessary, but a financial system doesn't really work too well without them. And so these are lending, margin, and leverage. So most financial systems have some sort of lending component. In the traditional financial system, it's things like corporate debt, individuals have credit cards. There's various ways to get access to credit. In cryptocurrency, we finally started to see the first of these protocols come out, things like Compound, protocols like Aave. These are protocols that enable you to basically borrow against your cryptocurrency. There's also companies that do this. BlockFi is an example of a company where they let you borrow against your Bitcoin and Ether. They also let you lend them out and earn an interest rate on that accordingly. The last 2 pieces are margin and leverage. These are much harder to do decentralized. There's a lot of risk. You basically have something where it's not fully backed by a dollar. You're basically effectively taking a bet when you're opening a margin position, and you can get liquidated. And especially when blockchain tech isn't super scalable yet today, those are kind of harder components to create, but people are making them. And so the kind of last thing I'll touch on before kind of moving on to like barriers to adoption is liquidity. So if you have this new financial system, it sounds really exciting, it sounds really neat, but any financial system is useless without underlying liquidity. Any of these markets need to be fair. That's really important that they're fair to trade in. And it needs to be relatively easy, cheap, and fast to participate in them as well. And those tend to be a lot of the benefits of blockchain tech, especially once some of the barriers, which I'll mention in the next slide, get eliminated. And so right now, blockchain-based financial markets are relatively small. They've been growing very quickly. If you look at the decentralized finance space, there's about $12 billion or so in capital kind of locked up participating in these protocols. And I think that's going to continue to increase. And it's kind of a testament to how exciting the tech is that many people are using it, even when it's really not too cheap or fast to participate yet. And so that kind of comes to like, what are the barriers to preventing this from becoming something really big, something that people even outside of the cryptocurrency space will be excited about, and something that really does transform how finance works. And I think there's really 3 main barriers. One is infrastructure. There's a lot of R&D going into this, like from a ton of different companies. And right now the infrastructure is pretty difficult to use, especially comparative to the traditional web stack. So if you look at something like, building in JavaScript, that's quite easy to use. It's pretty easy for a developer to kind of pull something off the shelf and start building. 5 years ago, that was almost impossible in the blockchain space. Now it's much more possible. It's not easy, but it's getting there. And I think, within another 5 years, it'll be really easy to build on. The next 2 are fiat and crypto on-ramps. So this is something that, a lot of the work Ripple does actually intersects with this, is, how do you get people into cryptocurrency. Whether that's an institution, whether that's an individual user, you basically need to kind of bridge the existing financial system with the new blockchain-based one. And then maybe, 20 or 30 years from now, we're sitting here and everything is blockchain-based. But there's going to be that bridge period in between. And then the last one is scalability. To support kind of these global financial applications, you need blockchains that are quite scalable, that do lots of transactions per second, and that have also relatively low latency. Most users are not comfortable waiting 30 seconds to a minute for something to happen. People are just, fairly impatient these days. And so they want something that's much more instant. This is kind of a high-level overview of what different projects there are in the decentralized finance space. Kind of starting at the top, you have these aggregators that basically take a bunch of different use cases and let you access them in kind of one simple to understand UI. An example of this is something like InstantApp. It's a UI that basically lets you interface with all these DeFi applications and smart contracts and stuff. And it's sort of like you can almost sort of think of it like your blockchain-based bank, except you own your money, you custody your funds. It's kind of entirely peer-to-peer. And there's no like middlemen, you just custody your money. The next ones are lots of things you already talked about, things like lending, where you have MakerDAO and Compound, decentralized exchanges, things like 0x, Uniswap. Things like oracles with an interesting problem in DeFi. How do you get data about the real world into the blockchain? That's useful for various financial contracts, where you kind of need data about something that happened in the external world. How do you get that securely without kind of just trusting one person? And then the last two big categories are like marketplaces and stable coins and payments. So things like Terra, things like Flexa that are kind of focused on the payment side, and then decentralized marketplaces that they're not like DeFi apps per se in the sense that they're known like trading or financial apps, but they inherently involve transacting with multiple parties on multi-sided marketplaces. An example of that is something like Filecoin, which is a marketplace for file storage, or something like Origin, which is a sort of sharing economy protocol where you can access, things like decentralized versions of Airbnb. And so now I'm going to kind of walk through in specific detail some of these projects. And then at the end, we'll kind of walk through some of these projects that are more specifically focused on payments, remittances, exchanges, that sort of stuff. And then at the very end of the presentation, I'll just walk through kind of the growth that the DeFi space has seen. I think it's really important. It's been something I've been super passionate about for like 6 or 7 years now at this point. And it's finally starting to take off. And there was a long period where the growth just felt like a flat line, but it's finally growing quite rapidly. But I think it's kind of important to understand what are these interesting protocols that people have created? What do they let you do from a very practical sense? So the first one I wanted to walk through is Maker. And so what Maker does, it's a borrowing and lending protocol. It lets you basically give it Ether or some other cryptocurrencies and borrow against it. And when you borrow, they give you a new cryptocurrency, actually. It's called DAI. It's a stablecoin that's pegged to the US dollar. So basically you deposit $1,000 of Ether and you borrow, say, $300 of DAI. You start accruing interest on that. Eventually you have to pay the DAI back. And the idea is that this DAI stablecoin is effectively backed by the collateral in Maker. And so it's sort of like a debt issued currency almost. And it's a very kind of powerful notion. It's sort of the first project of its kind. They were developing it for a very long time, since like I think late 2014 or early 2015. It finally launched in, I believe, late 2017, early 2018. That's sort of like one of the first big DeFi projects. The next one that I wanted to mention that's somewhat similar is called Compound. And this lets you borrow and lend crypto assets, again, without any middlemen. The difference is it doesn't produce a stable coin as a byproduct. It's just a pure, basically money market borrowing and lending system. The next category is decentralized exchanges. So here you really have one kind of big front runner, and then you have a bunch of people competing with them. And then you have some other alternative approaches that I think are interesting and I think long run are kind of more likely to win out in the long run. So the big front runner is Uniswap. Most people in the cryptocurrency space have heard of them. What most people don't know is that it's an idea that's actually quite old. There are a couple folks who kind of tossed around this idea for what if you could trade cryptocurrencies where there's actually no like order book, there's no market maker explicitly on the other side. You instead just kind of throw funds into this smart contract and it basically automatically trades and it automatically provides liquidity using an equation. And it's actually kind of a really old idea, actually borrowed from the prediction market space, where people have been using these equations for a long time. And I think a guy named Alan Liu and also Vitalik proposed it at one point, basically proposed, what if you applied this to just regular trading? And that's sort of kind of the genesis behind Uniswap. The next one is 0x. And 0x is a decentralized exchange that uses an order book model. Now, they don't have nearly as much traction as Uniswap for the reason that order books are just not an effective way of trading on blockchain today because of the cost, speed, and latency issues. And so 0x does actually offer, in many cases, actually better pricing, but it's typically more expensive to trade if you're kind of doing a lot of active trading. And I think once kind of layer 2 system exists, I think in practice what's going to happen is 0x is going to get a lot more popular. I think their growth is going to really pop off once you can do these trades for, under a second, and it costs, 1 or 2 cents to do it. But right now, the kind of Uniswap model is much easier to understand. It's simpler and it kind of works in an environment where transaction costs are quite expensive. Next, you have payments that are kind of the more DeFi payments. And then later we'll walk through kind of the more centralized finance payments that bridges the gap between these two ecosystems. On the DeFi side, there's a company called Terra. It's basically a blockchain payments network, its own blockchain, and they power a bunch of payments in Korea. And what's interesting about it is it also issues a stablecoin as a byproduct. So they're basically taking this kind of new system that they designed, it issues a stablecoin as a byproduct, and they're using it to process payments for a bunch of merchants in Korea. The next one is Flexa. This is kind of a bit different. It's more processing payment in the United States, and it uses cryptocurrencies that already exist. So whether you have something like USDC, DAI, Ether, Ripple, Bitcoin, whatever it is, you could use it through the Spend app to basically pay for things in kind of physical retail locations across the US and Canada. Aggregators. So one other thing to mention on the aggregator side, I walked through Incidap earlier. The other one's really interesting is called Yearn or Yearn Finance. It's basically a portal to various DeFi projects. And it effectively what you do is you give them your money. So say you have USDC, or say you have DAI, or say you have Ether, you'll give it to Yearn, and it will sort of automatically manage it to earn you as much yield as possible. And then they'll basically pay you the profits minus, I think, like a 0.5% fee. And maybe it's 1% fee nowadays. And it's really unique because any developer can go out there and write one of these new strategies for basically optimizing the assets that you give it. It's sort of like the world's kind of first on-chain autonomous cryptocurrency hedge fund. And there's about $750 million in value locked up in this vehicle, which is kind of really interesting and exciting and powerful. And I think it's actually kind of a huge moment in finance that something like this is even possible to exist. On scalability, we mentioned how there's a lot of barriers to scalability, how it's really hard to scale in this space. There's a bunch of different approaches to this. Some people are building things called layer 2s on Ethereum to basically make it really easy to deploy your dApp onto it and kind of run it in a more scalable fashion. There's also other blockchains trying to do this. One example of this is Polkadot. It's founded by the guy who used to be the CTO of Ethereum, Gavin Wood. And they actually launched a mainnet already. The downside of Polkadot, though, is that it's quite hard to deploy existing Solidity contracts, the programming language on Ethereum, into Polkadot. They're working on making that a lot easier, but today it's not quite there yet. And then the last thing in scalability is Ethereum itself is working on ETH 2.0, which is supposed to be this kind of massively scalable new version of Ethereum. And the first part of that's supposed to launch sometime in the next few months. And then kind of lastly, on the more kind of centralized bridges between DeFi and decentralized finance, the two examples I wanted to highlight are Coinme and BitSo. And so these are kind of like really actually quite used in the real world. What Coinme is, it's a platform that basically is software that runs on these Bitcoin ATMs and kiosks located in places like grocery stores, where people can basically very easily convert their cash into crypto. And it's growing really fast. It's actually quite popular. And there's not really any other good kind of cash on-ramps. There's a lot of on-ramps that assume you have a bank account, that kind of assume you have access to the banking system. And those work great for people that do. But if you don't, or if you just want to buy $100 in Bitcoin, you don't want to wait, 3 or 4 days, you can use something like Coinme to do that. The next one is BitSo. And BitSo is really interesting because it's basically a Latin American-based cryptocurrency exchange, and they power roughly 7% of the U.S.-Mexico remittance corridor. I remember getting in when I got into crypto, a long time ago. One of the things people always said is, "Oh, Bitcoin's going to be used for remittances," and for quite a long time, it didn't really happen too much. But now it's actually happening. Like this is a real use case. People are using it for remittances, and that's really exciting to kind of finally see something like that. That's pretty practical out there in the real world. And so I just wanted to walk through those examples to sort of give people kind of an overview of the DeFi space, sort of how we see it, what sort of interesting projects there are in there. Some of those things were investors in at Pantera, some of them were not. I just wanted to kind of pick some select examples that are sort of market leaders in sort of the various kind of subsectors of DeFi. The very kind of last thing I wanted to go over before wrapping up my talk is growth in open finance or decentralized finance. And there's really two metrics that you can look at. One is kind of total value locked, or this concept of how many dollars are locked up in DeFi applications. So one of the kind of core theses is that, DeFi is going to be a main driver of value to the space. What does that look like empirically? Well, it's happening. In January 2018, there was only 100 or 200 million or so locked up in DeFi apps. January 2019, you're starting to get up to like 300 million or so kind of ballpark. January 2020, about $1 billion. And then now we're sitting here in October now, 2020, and it's around $11 to $12 billion right now. So it's growing very fast, very small in comparison to traditional finance. You have companies like BlackRock that have, I think, over $1 trillion under management. But only 2 years ago, it was like 100 million. So it's growing super, super quickly. And I think that pace is going to continue for quite some time. And the last metric is decentralized exchange volume growth. What's cool about these metrics is they're very easy to track. If you ever want to check in, see kind of how's DeFi doing, you can track the PVL metric on DeFi Pulse. For the other metric, decentralized exchange volume growth, you can look that up a few different places. The source I'm citing is one that's called Dune Analytics. You can look it up for specific DEXs on CoinMarketCap as well. But the punchline is the volume for that has been soaring as well. In January 2019, it was so small, it's a blip. It basically rounds down to zero. January 2020, you're looking at a couple 100 million a month. September 2020, volumes hit 22 billion. So it's now starting to become, definitely not as big as centralized exchanges, but the market share is no longer meaningless. It's actually starting to become a meaningful number. And so that's sort of how we see the DeFi space. I think it's going to be the next sort of big growth area for cryptocurrencies. And I think if you look at the question, like, how can this tech impact the world as much as the internet impacted the world? I think it has to be through decentralized finance and companies that either assist that or help power it. Digital gold is really cool. I'm a huge fan of Bitcoin, but I think if you look back, on this tech 30 years from now, I think the answer is going to be decentralized finance is what actually made the kind of huge 0 to 1 shift in society. Thanks, everyone. I hope you learned something useful. Next up is some partner demos with PayID. And later, I've heard that there's a grant program with RippleX, which you should definitely check out, especially if you're a developer working on something innovative.
Hey everybody, my name is Sean Rowland. Wanted to thank the keynotes we just watched. That is some really exciting stuff happening in the crypto industry. And to show a little bit more of the practical application, what we at BitPay plan to be having in our app, the BitPay app, is a little demonstration of PayID. So I lead the product management and the product design teams at BitPay. BitPay is the largest global payment processor in the world. We process payments for companies like AT&T and Newegg, and we also have a non-custodial BitPay app, and as well as a debit card in the US that you can attach to that app. But what we're going to be showing today is PayID in our non-custodial app and sending and discovering and verifying someone else's PayID. So we'll go ahead and get into that. But one thing I wanted to talk about a little bit first is why BitPay decided to join the PayID and take part in this protocol and kind of building it out in our own ecosystem. It solves a lot of problems currently and in the future where we're seeing payments go. One of the key issues that addresses in the crypto space is, hey, I've got these really funky addresses. I've got to save it and remember my friend Marty or my sister Jenny. I've got, oh, this is her crypto address. I need to send it. Even if she shares it to me, then I might mistype it, etc. A lot of ways to mess that up. And PayID is a really nice way to kind of have like a permanent web of trust address book, that all my different peers and eventually merchants, I can really use this as an overall value transfer mechanism without having to remember someone's Venmo account, and someone's BCH, and someone's BTC address, or someone's XRP address. So again, a lot of really good things that it solves now, PayID does, as well as in the future. So I'll go ahead and show that demo and start kind of talking through a little bit of that. Okay, so right here, this is in the BitPay app. You can go to iOS or Android to download it. And this is once you have created a wallet and you've added funds to it. In this wallet, there's Bitcoin, Bitcoin Cash, ETH, XRP. And I've clicked into one wallet. And again, this is one master key that controls all these different individual currencies. So I want to send. I want to send from one of these wallets. And what also shows you, oh, I've got these contacts. Like, who do I want to send this to? And you notice it's not like it shows addresses or for XRP or for ETH. It's showing me in these cases, here's some great PayIDs that I might want to pay to. But in this example, I'll say, hey, I've got my friend Marty. It's the first time we're sharing PayIDs. I want to make sure he is him and he has control of the addresses behind PayID. So I'm going to also verify him. So I'm going to go ahead and say, all right, Marty, what's your PayID? And he's going to tell me, hey, it's Marty $savant.com. I'm like, cool. I type that in. The BitPay app then searches it across the entire PayID protocol. And then what happens, I'm like, oh, hey, Marty, you're not verified. And imagine I'm on the phone with him. And I'm like, hey, I want to make sure this is you. This is the Marty. You control this PayID. Will you go ahead and verify your PayID? And so what he has on his app is what he'll pull up, verification process. And he'll read off these set of numbers to me. And if he reads off a different set of numbers, that means that, hey, this is the wrong Marty $savant.com. I need to research. I maybe typed it in wrong. But if he reads these exact same numbers off to me, this is kind of some back-end encryption. If you're familiar with PGP, some similar concepts there. This is how I'm going to verify 100% that Marty right now on the phone controls that PayID. And I'm going to be sending money to Marty. So I'm like, great, you're verified. So what that does, cool. All right, is verified. And what's going to happen is BitPay, we automatically add that to your contacts and as a verified contact. Because what we really want to be happening is a web of trust being built up. Oh, I see. Eventually, like, you know, my sister Jenny can see that I trust Marty, and that can help her then trust Marty also. But really building up a big address book of verified contacts that I can send payments to without worrying about sending to the wrong address or the wrong name. So that's kind of the verification process. And from there, it's pretty simple. This is the BitPay send screen. I just want to send a little bit of Bitcoin to Marty. It shows me who it's sending to. It's showing me he is verified. And then what's happening is when I slide to pay here, on the back end, they're like Savant, $savant.com. They are running a PayID server, and they have Marty's addresses for Bitcoin tied to his name. So I am sending to an address on the back end, but it's showing like I'm just sending to Marty. That's kind of the beautiful thing and the cool thing about what PayID can do. So I'll go ahead and slide, payment sent. Marty received the money, and from that point forward, he is a verified user, and I can send any amount of money to him and can at least trust that he is in control of that wallet, also of that name, that PayID name. So with that, that is PayID. Within the BitPay app, you can go to iOS, Android, and download the BitPay app. We've got a cool US debit card. It's non-custodial. You control the keys. And we've got some real cool new features coming in here like PayID. So check it out and appreciate it. Thanks, everybody.
It's great to hear from David, Stephen, and others on their take of the events in the crypto industry. Our industry is definitely full of very exciting future and very interesting times ahead. My name is Chris Choi, and I'm the product lead of Crypto.com Pay. Crypto.com just celebrated our 4th year anniversary, and we currently have more than 3 million users and growing. Our mission is to accelerate the world's transition to cryptocurrency. Our services range from exchange, wallet, card and payments, and most recently, we have launched a bunch of DeFi features as well. PayID is something that we see that fits in very well with our mission. It makes payment between peer-to-peer and even peer-to-merchant a lot easier. So without further ado, let me demonstrate how to register a PayID on our Crypto.com app. So just open your Crypto.com app, go to Settings, and you'll be able to see PayID. Click Register PayID. All of our PayIDs within Crypto.com would end with $PayID.crypto.com. So if you like our domain name of Crypto.com and you want a PayID ending with Crypto.com, this is the place where you want to register your PayID. So in this instance, I'm gonna type in Chris, and I'm gonna register my PayID. Done. As easy as that. So my PayID is CHRIS$PayID.crypto.com. So now I'm gonna pass it on to my partner Adam, and he's going to demonstrate how to send funds using PayID from his platform to mine.
Thanks, Chris. Hey everybody, it's Adam here from the Bitrue team, and I am so excited to be here with you today showing you how you can register and use PayID to send and receive XRP on Bitrue. XRP has been the cornerstone of Bitrue ever since our exchange started over 2 years ago. We were the first exchange to adopt XRP as a base pair. We now have over 50 XRP trading pairs. We were the first to offer an XRP investment option with PowerPiggy, and we're honored to now be among the first exchanges to let you transfer your XRP with PayID. If you've ever sent XRP to an exchange, you'll likely be familiar with the tag system. You need to include the correct tag associated with your account in order to make sure that your XRP arrives correctly. If you forget the tag or type it incorrectly, it can cause big problems as your as your funds go missing for a few days. But PayID is going to fix this. In the future, you won't need a tag. All you'll need is your simple, memorable, speakable PayID. And today we're going to register and try out the address adam.payid.bitrue.com. To register your PayID on Bitrue, just head to your deposit page, select XRP, and then select PayID. Then enter in the name of the address that you wish to use, and then click Generate New Address. To send your XRP, just head to the withdrawal page on Bitrue, select XRP, PayID, and then enter in the PayID address that you wish to send to. Then select the amount and enter your PIN code, your email withdrawal code, and your Google 2FA code to continue. And that's it, your XRP will be sent.
Thanks, Adam. Thanks for demonstrating how easy it is to register a PayID and sending to a PayID on your platform. So let me just check on crypto.com wallet app again. Let me open up my beautiful crypto.com app and see, yes. So I can see, as you can see right now, 50 XRP just received from Adam. So there we have it. That's how easy PayID is. Thanks for having us, and hope you enjoy the next demo. Thank you.
Good morning. Thank you to the previous keynote speakers. It has been amazing to listen to all the progress has been done and will be done in the future with PayID. I am Sergio Mello. At heart, I want to bring technology to mainstream. FinTech, in my opinion, started in 1872, when Western Union connected the two ends of the United States with a telegraphic line, and immediately after started delivering money transfer services on the same line. Those services are still called telegraphic transfers. In my lifespan, I witnessed in 2003 the launch of the first 3G network in Italy. I was doing video calls at the time. And in 2007, I was living in Korea and I witnessed the launch of the first mobile money system that was based purely on smartphones with NFC contactless payments accepted throughout the whole country directly from a bank account or a self-contained wallet in the phone. And now I would like to bring everything one step forward. So I'm working with Tangem, where I'm the CEO, and we work very hard every day to provide universal access to digital assets. You may already know our cards. We produce these beautiful, fantastic, high security hardware wallets that are a self-contained key management system. I have the power of a hardware security module and the usability of a Metro card. This is a fundamental component in our solutions for payments and identity and authenticity. They're based on a secure platform, certified, EAL6+, audited firmware, which is proprietary, audited by Kudelski Security, can sign transactions with elliptic curve within less than a second. And as I said before, the most important thing is that the key lifecycle is completely self-contained within the cards. So when we use the card, we have a key management that is physically available and portable, and we have an interface that loses all the importance, the relevance, and the need for security and trust. So we basically disintermediate trust, and we draw a straight line that goes directly from a physical object, which is a card, to a blockchain asset. All of a sudden, you no longer need a phone or a computer to hold your assets. Asymmetric cryptography and blockchains have propelled the digital world to new heights. We sit pretty high now, but ultimately security is down to the weakest link. And if the weakest link is intermediary and transport of information between sender of money and a receiver, then we do have a vulnerability. So we have solved how to go to market with a product that is for mainstream, but we still need to make sure that when I tell Chris my PayID address, he can verify and make sure that no man in the middle, no trusted platform in the middle has manipulated that data in order to operate fraud. So what we're going to show today is a way to use the properties of asymmetric cryptography applied to a verification of a PayID address. My Tangem wallet app is now able to generate an identity key. This identity key, the public part of the identity key, can be shared directly on a back channel, and the wallet address stored in my PayID account, PayID profile, is signed with the identity key. Therefore, I can show you the flow. When I scan a card, I create my own PayID account. I'll create Sergio M $PayID.tangem.com. I create this PayID, and I see that my phone has generated also an identity key. It's now not time to ask for an inbound transfer. Hey, Craig, how are you?
I'm good.
Fantastic.
Okay,
Would you like, please, to send me 10 XRPs? You know, my PayID address is Sergio M $PayID.tangem.com.
Okay.
And if you want to verify it, this is the print of my public identity key.
Awesome. Would you share that with me via Signal?
Absolutely. Let me do it right away. Okay. Did you receive it?
I got it.
Perfect.
Thanks, Sergio. Hey, everybody. My name is Craig DeWitt, the founder of PayBurner. PayBurner is founded on the simple premise that you should be able to move your money as easily as sending an email today. And so because of that, we built a number of products, including a browser plugin that allows you to send and receive and request XRP in a non-custodial fashion, meaning that you are the one who owns your funds, and you and only you can control where you send it, how you receive it, and what you use it for. We also have an ecosystem built around PayBurner of digital websites like XSongs and like crypto stickers and many others that allow you to use this plugin for one-click payments to buy and sell goods online. One-click checkout experience across the entire internet using the best asset for digital payments, XRP. One of the core pieces of what PayBurner does is it gives you control over your value. And really what I'm excited to show with Sergio here is that with verifiable PayID, now you're also in control of your identity as well. So you can really do a self-sovereign check of the identity of the actual wallet and PayID without relying on PayBurner or any centralized server. So what I'm going to do is I'm going to send Sergio some money. So I'm going to come up here into my browser plugin. I'm going to select Make Payment. I'm going to select PayID, and I'll put in Sergio's PayID. Okay, and what you see now is the verifiable thumbprint for his PayID. Then I'll just do a visual check based on what I have in Signal that Sergio sent me. I'll just make sure that these line up. They line up. On a peer-to-peer basis, we've just evaluated each other's PayID, so now I can be sure that the person I'm sending funds to really is Sergio on the other side. And now I'll just put Sergio with 10 XRP, and I'll press send. And there you have it. Instantaneous value transfer with a self-sovereign PayID, easy to send in an email.
And let me check. Balance validation. Fantastic. Thank you so much. I just received your XRPs. This feature is live now. It's available the Android and iOS app stores with the Tangem Tap app, which has just been relaunched with new features and a new user experience. We're very happy that we are at the forefront of innovation on all sides of the story, and PayID is absolutely marrying our philosophy of interoperability and utmost security, where you push the trust to the edges. People should be able to manage their own identities, their own trust independently from the network. Thank you very much for listening today.
Thank you. It's great to hear from the keynote speakers. The future of payments looks bright and inspiring. I'm Marcus, co-founder and CEO at Tova Labs, and we are making it easier to store, send, and receive crypto assets. For the past few months, we have been collaborating with CoinField to develop a new app called PayMe Plus. With PayMe Plus, you can replace complex wallet addresses and account numbers with a simple universal payment ID. In our presentation, you will hear from Reza Basar, one of our founding members. We will show you a demo of PayMe Plus, and we've also created a commercial. Now let's hear from Brent, who is going to tell us more about PayMe Plus.
Hey, I'm Brent. And I'm Brent. Oh, hey, good to see you. Listen, I need your help. Oh, what's the problem, Brent? Well, Brent, I love crypto, but sending and receiving payments can be so frustrating. I can instantly and easily send messages and email to people, yet sending crypto payments is just as hard as it was 10 years ago. Wallet addresses are too long and complicated to remember, and it's too easy to make a mistake. Well, Brent, I have some good news for you. Let me tell you about PayMe Plus. Every day, millions of people send payments globally. PayMe Plus makes receiving payments as easy as sending and receiving email. No way. Yes way, Brent. Imagine a world with no more confusing wallet addresses. Now you can send crypto using a simple, easy to remember address. How does PayMe Plus work, Brent? I'll show you. But first, let's hear from one of the founding team members of PayMe Plus.
Thank you, Brent. And hi, everyone. Hope you're enjoying this event so far. As Brent mentioned, hundreds of millions of people around the world send and receive money every day. And yet, there's no universal address for payment networks. Thanks to PayID technology and the PayMe Plus app, this is not going to be the case in the future. PayMe Plus is an incredible app that uses the PayID technology to allow just about anyone to obtain and manage their PayIDs without relying on third-party service providers. Combining security and usability, we have designed the app to be an ultimate tool that takes care of all the user's receivable addresses, such as crypto addresses, PayPal, Venmo, IBAN, and so on. We're excited to be releasing the PayMe Plus app, so let's go back to Brent so we can all see a demo together. Thank you.
Thank you, Reza. Now, let's take a look at PayMe Plus in action. After installing the PayMe Plus app from Google Play or the App Store, you'll be greeted with a short introduction. If you're a new user, you'll need to create an account, while existing users can log in. To log in, enter your email and password, and your two-factor authentication code. This is the main screen of PayMe Plus. In the top left is the menu. The content area shows your PayID, labels, added payment networks, and a button for sharing your PayID. So far, I've added 2 payment networks, the Bitcoin and Ethereum blockchains. I'm going to add a third. To add a payment network, you have 2 options. Just type, paste, or scan a wallet address, or select a payment network from the list and enter your details. PayMe Plus also supports traditional payment networks, such as PayPal. When typing, pasting, or scanning a wallet address, PayMe Plus will auto-detect what network it belongs to. PayMe Plus has detected that this address belongs to the XRP ledger. At this point, select which PayID this payment network should be added to. It could be your primary PayID or a PayID with a custom label that you've created. As a final optional step, you can select which currencies you prefer to receive in this payment network. You then see a summary of all details. The XRP ledger address has now been added to my PayID with two preferred currencies, XRP and Solo. Now I can share my PayID and get paid on the Bitcoin, Ethereum, or XRP network. To do this, I tap the Share button. My friends can either scan the QR code on my phone, or I can click the Share PayID button, which allows me to easily share my PayID via a messaging app like Signal or Telegram. PayMe Plus is capable of managing multiple PayIDs, so I'm going to create another one. Type your desired PayID name. It could be your nickname, real name, or anything else you'd like. You have the option to create a public profile for your PayID. You can name this profile, give it a description, and upload a profile image. A public profile is useful when your friend is using a service or wallet without PayID support. Simply send them your public profile link, where they can copy and paste your wallet addresses. Here you can swipe between your favorite PayIDs and add labels to them so you know which is which. It's a bit like having multiple bank accounts in one place. I'm going to label this PayID Savings. Now I have one PayID without a label and one with the Savings label I just created. Each PayID can have different payment networks attached. In PayMe Plus, security and privacy come first. PayMe Plus will support verifiable PayIDs, where your device signs the payment details locally, making attackers unable to modify lookup requests. PayMe Plus will also allow you to verify your website or social media handles, giving your contacts stronger confidence that your PayID belongs to you and not to an imposter. So what do you think, Brent? I think Christmas has come early. So how do I get PayMe Plus? All you have to do is go to www.payme.plus to find out more, and you can download the PayMe Plus app on the App Store and on Google Play. Oh, thanks, Brent. I can't wait to start using it. PayMe Plus, so simple. Thanks for listening, everyone, and enjoy the rest of the event.
Thank you, Reza and Brent, for that demonstration, and thank you everyone for watching our commercial. As Brent mentioned, you can download PayMe Plus from App Store or Google Play. And PayMe Plus is entirely free to use. I hope you enjoyed this presentation, and I hope you enjoy the rest of the event.
Hi, I'm Robert Swarthout. Today we're going to spend some time talking about payidvalidator.com. This past summer, I participated in the PayID hackathon. Prior to the hackathon, I was working on building a PayID server that was based on AWS Lambda when I realized the server that I was building may not be responding correctly according to spec to all the different headers and response body types. I built the validator to help other developers try to find the issues that they may be accidentally building into their app when they're integrating PayID into an existing system and not using the PayID implementation server. The payidvalidator.com system will help you find any and all problems that you're having that would allow other applications to easily interface with your PayID. The first address that we're going to use is an address for the XRP Tipbot wallet on BitHump. We're going to choose XRP mainnet. We're going to click validate. Validator goes out. This particular server on BitHump received a 100% score on all passes. You can see the response headers as they came back. These are untouched and fully for debugging purposes. You can see that a 200 response was returned by the server. We also do a check to make sure that you're not exposing the admin APIs that are provided with the implementation server that the PayID team has released on payid.org. In this case, it was not exposed. And we do some access control header checks for the different access control headers here, and checking to make sure that, in this case, that we only want to see get and options values in this particular allow methods header. Further down here, we're going to see that we're checking to make sure you're exposing certain PayID headers. The cache control header is a no store, that is per spec. and the content type does say application JSON. We're starting to get into the meat of the response body here. The validator does a check for the wallet. In this case, it's just the generic default addresses object here. Multiple addresses can be returned. We do a lookup on this XRPL mainnet address, and just to help the developer, we do look up and say, oh, you have this much XRP in your wallet. And the last header that is checked is the make sure the response body is of the correct type, XRPL mainnet. That's the request that we sent. Let's do another check for a different wallet so we can show that some servers are actually not responding with everything correct. I'm going to choose all here. This is also going to show you that the this server has multiple addresses set up for this pay ID. You can scroll down, you see they got a score of 92%, but what failed is they have post being included in their allowed headers. This is not current. This is not the correct value to be shown in the current spec. You can see down here the payload. They do have an XRP mainnet, Bitcoin mainnet, and Ethereum mainnet. Another thing we are going to demo here is with PayID version 1.3. There is a the ability to pass in or to return verified addresses. So cryptographically signed PayID addresses can be returned in the response body. So in this case, the addresses object is empty, but the verified addresses is provided. You can see that 100% pass here, and the signatures and are validated against the PayID, and everything is 100% correct here. An example of when it does not work is this here, and we can see the validator is going to return a non. It's basically a little under 100% here because the signature does not match what was intended. And I purely just wrote bad signature at the beginning of it, but that you can kind of get the point. One other thing, part of the validator that was recently added is a PayID generator. So think of flipping this around. You are building an app and you want to test to see if your application is processing PayIDs correctly. If you were to make a request to this PayID $PayIDvalidator.com, you would get back 100% validated response that actually has addresses for all these different payment networks down here. That's great, but you also may want to test use cases where you have a bad CORS header or there's a malformed JSON body. You check that. Now you can use this PayID-18, and it kind of provides you a bad response, whatever bad is intended to be for this use case. You can check all the boxes. You can check one, whichever you prefer. You copy it, you use it. It's pretty simple. I appreciate everybody spending time watching this. If you're interested in spending more time helping suggest ideas, or if you find bugs, there's a link to the GitHub repo in the footer of the website located at payidvalidator.com. The validator is all open source and would love any contributions. Thanks and have a great day.
Hi, my name is Tyler Storm. I'm a senior software engineer at Ripple. I build tools and products that help developers use the protocols and APIs that Ripple provides. Today, I'm going to be demoing one of those tools, the PayID Sandbox. For those of you who do not know, PayID is a universal payment identifier that allows you to have a single identifier for all your different payment rails, such as Bitcoin, Ethereum, XRP, potentially even Venmo or ACH. You can have all of these combined into a single identifier, such as Tyler $PayID.org. When talking about PayID to developers, they usually want to have a quick way to try PayID before they invest their time and resources into building or deploying PayID into their stack. The PayID Sandbox allows developers to do just that. I'm going to walk you through the PayID Sandbox and show you how easy it can be to use PayID. So in order to set up your PayID Sandbox, you're going to have to go to payid.org and click the sign in button in the top right. We will be signing in with GitHub. Hopefully every developer here has a GitHub account they can sign in with. It will request you to authorize the PayID application for your email address data, so we can then send you guys emails on updates around PayID. Here you'll specify your name, as well as your email and your company. The email is already filled out based off of the GitHub email. And then here's where you can define your virtual PayID server. So effectively, we're going to be able to register PayIDs to whatever the virtual server domain that you select here. So for this, I'm going to say PayID demo. So I'm going to create a virtual server domain of PayID demo. And then as you can see here, now we own this virtual server domain of payiddemo.sandbox.payid.org. In addition to that, you will also receive an admin API token. The admin API token will allow you to call the private APIs on the virtual sandbox, such as create user, update user, and delete user. So let's jump into the GUI and see how we can create PayIDs using the sandbox. So here we're going to create a PayID, and we're going to call this PayID Tyler, and we're going to select the XRPL payment network, and then we're going to put this address in as our test address to assign to this PayID. So if we look over here in the right, we're going to see what information we're going to be sending to the server. So this is a curl snippet that tells you exactly where the destination is that we're sending to, what the version is that we're sending it under. Here is where you can see that authorization bearer token that we talked about on the previous screen, and this authenticates your account to make these requests. The data raw here that you're seeing is the PayID that you specified, which is Tyler payiddemo.sandbox.payid.org, as well as the addresses that you are sending to register to that PayID. So I'm going to execute this code, and we'll receive a response back from the server. This is saying that we successfully registered the PayID, and we registered it to this XRPL address. Now, if you look under the JavaScript snippet, you can see the Axios code. If you were to write this code in JavaScript, you would use this format to do the exact same thing that we just did in curl. Now, if we want to call this PayID and get the information from it, it's exactly the same as calling any public PayID. And we are going to go over here and we're going to specify Tyler, and we're going to say the XRPL network for testnet. And if we execute this code, we get back Tyler's PayID demo at sandboxpayid.org. And you can see here the exact address that we specified. There's also the ability here to replace and delete users as well. But you're going to have to try that one on your own. If you would like to set up your own PayID sandbox, please visit payid.org and click the sign in button in the top right corner. If you'd like to integrate PayID into your stack, please check out our documentation at docs.payid.org. If you'd like to join the community and discuss PayID with us, please check out our Discord server, which can be found at chat.payid.org. Thanks, everyone, and enjoy the rest of the event.
Hello, everyone. My name is Ian, and I'm a member of the Ripple engineering team. Today, we're going to talk about how to set up a PayID Lambda-based server from a CloudFormation stack. The problem we're looking to solve is trying to run a PayID server with the lowest investment possible in terms of time and money, while still having a reliable server available for users to access. We know that setting up DNS and SSL certificates can be difficult for a lot of people, and this process should eliminate most of the headaches involved with doing so. We're going to be working from the GitHub project spring-eng, so xpring-eng /payid lambda. And to go through the steps, you're going to need a few things. You're going to need an AWS account, a domain you want to use for your PayIDs, a certificate imported into Amazon Certificate Manager, specifically in US East 1 for compatibility reasons. And after you finish launching the stack, you're going to have to update the domain that you use to reference the name servers that are listed in the Route 53 hosted zone that the CloudFormation stack will set up for you.
To start off, since this may be the most unfamiliar part for most people, we're going to talk about just how you get a certificate for your domain into the Amazon Certificate Manager. Right now, we're in the Amazon Certificate Manager in US East 1. And what we're going to do is we're going to click Request a Certificate, and we're going to select Public, which is a free certificate that Amazon will issue you. If you've already generated one, you can import it as well. But in our case, we haven't, so we're going to have Amazon generate one for us. We have a domain registered already through the provisioner Freenom, which is a free domain provider, and we're going to paste it in here and click Next. We're going to choose DNS validation. We're not going to add any tags. Go to Review, and then on step 5, the console is going to tell me that it's pending validation. In order to get this validation step to pass, we're going to have to paste these two values into our registrar's DNS settings. Now that we have these pasted in here, we're going to save the changes, and we have to wait for the registrar to update this record, and we have to wait for Amazon to pull it for us. This can take a while. Sometimes it takes 30 minutes. Sometimes it could take longer. Luckily, we don't have to wait right now because we already have a domain available that has a certificate issued that we're going to use instead. The domain is lambda-pid-demo-video.ml, and we'll be moving forward with the demo using that. Now, it's worth pointing out, this is going to take care of 90% of what you would normally need to deal with when it comes to generating an SSL certificate and messing around with DNS settings. There's one more step that we'll have to take at the end, but it's a very easy one. Now, to prove this wasn't already up and running, we're going to try and hit the URL that the test account would appear on and show that it's unreachable. We can also see that the PID validator says the same thing. Both of these has failed, which means we're not up and running already, so we're not cheating the process by having something that was working. We'll be using this domain when we go to launch our stack. We click Launch Stack, and we're already using the template that we need via the button that was available on the GitHub project. Click Next, then enter your domain name. Click Next again, and then we can create the stack. This takes a few minutes to run through all of its steps, and you can click the refresh button to see it moving along. This is going to create a variety of serverless resources, including a few Lambda functions, 2 of which are used during the creation of the stack to derive values for us, and the other being the PID server itself. It's also going to create an S3 bucket, some API gateway endpoints, and a hosted zone, so we can use our certificate and domain with the API gateway endpoints we end up creating. This usually takes somewhere between 2 and 5 minutes to completely execute. And after it's done, we're going to have the values that we need for the name servers that our domain registrar needs to know about. Now, through the magic of video editing, we can see that the CloudFormation stack has completed. If we go back and look at the timestamps from start to finish, it took around 3.5 minutes to complete. Now that this is complete, we can go to the output and see the name servers that we need to enter into our registrar. All we have to do is copy and paste these 4 values into the form on our registrar site and save. This change doesn't necessarily take effect instantly. Once again, we're dealing with DNS, so it's depending on DNS propagation, which can be quite slow. Your domain might not show up instantly as a result of this. In order to test it, we're going to go to our domain, followed by /test account, which has our default account which was created by the stack. The URL loaded correctly, which means we're live. If we go to the PID validator and check the domain again, now we can see that we're passing. The reason for this not being 100% was due to an issue with PID validator not validating testnet accounts correctly, which is what we're using in the case of the test account that's set up with the stack. When it comes to the test account, the PID Lambda is using an S3 bucket to serve up PID entities. This bucket will have the name that you used when you created your stack, followed by the term S3 bucket, and then a unique identifier at the end. In here, you can see the testaccount.json file, which matches the name that we put at the end of the URL. If you want to add additional pay IDs, you just create more JSON files, and whatever the name of that file is will be able to be appended to the end of your domain to serve up that pay ID. And with that, we're live with a pay ID server. We went from domain to certificate to being hosted in the cloud with serverless resources within a few minutes time. If this was interesting to you, or you're just interested in pay ID in general, I'd like to take the time to encourage you to go to payid.org and sign up for the newsletter. And if you want to play around with the pay ID Lambda, go to github.com/spring-eng, XPRING-ENG/payid Lambda. Thanks for your time, and thanks for attending.
Hey everyone, thanks so much for joining us today. My name is Jen Yu, and I lead a team at Ripple focused on developer products and initiatives. I hope you enjoyed watching those product demos as much as I did. PayID has been such an incredibly fun, rewarding, and very collaborative effort led by a bunch of members of the Open Payments Coalition. This is the group that's been working on the protocol itself, but also supporting PayID as the addressing protocol for sending and receiving money across a variety of applications around the world. Today, the coalition has a user reach of over 125 million by companies who support PayID. It includes 7 of the top 10 exchanges, several wallets, and of course, a large group of developers who are not only working on the protocol itself, but also coming up with innovative use cases to apply PayID, like the ones that you also just saw. As you all know, PayID is completely open, built on open standards and protocols. It's secure with verifiable ID for wallets, and it's also incredibly easy and simple to integrate. We just rolled out a bunch of developer tools to make it even easier and faster. You can check out our PayID Dev Sandbox, as well as our AWS Lambda integration. Go to payid.org for more details. And if you're interested in seeing PayID in action, you can see it in a variety of places, including on BitPay, Bitrue, Crypto.com, and Coin Payments, where you can set up your own unique PayID. And if you're interested in joining the Open Payments Coalition, or just want to get involved in our mission for how to make payments more open, we'd love to hear from you. We'd love to invite you to some of our events in the future and collaborate with you. Also, a big thank you to our keynote speakers today, David, Stephen, and Joey. As you heard from them, and as many of you already know, the world of crypto and the many players in the ecosystem and the applications across payments and finances is constantly changing and evolving. And at RippleX, which is the developer platform at Ripple, we believe that the future of payments becoming more open is really predicated on the success of developers who are working on open protocols and making the entire ecosystem a lot more open than it is today. So to that end, RippleX is rolling out a variety of developer-facing programs. If you are an application developer, an infra engineer, a market infra developer, or just a developer who's starting to learn about the many use cases for crypto, we hope you'll join us. You'll see the link on the screen here. We have a bunch of grants that are coming up, as well as developer programs, educational content series, if you're just new to crypto. Our mission really is to support all of the developers and entrepreneurs out there by removing all the friction that comes with integrating blockchain technologies and making it possible for you and your users to send and receive payments across any currency, network, and geography. At RippleX, we believe that the future of money is open, it's interoperable, and it's reliable for a much better user experience and access to everyone around the world. And we hope you'll join the community collaborating to make that a reality. With that, thank you very much for joining us today, and we hope to see you at our next event.
Jen, and to all of our speakers this morning. We really hope you enjoyed the program so far. It's been jam-packed, very interesting morning, and we really appreciate all the demos and presentations that you've given. We're going to take a break and then pick up the programming again this afternoon at 2:59 Pacific Standard Time. We'll have more for you in line of today's crypto focus with some exciting panels, presentations, and discussions, starting with a fireside chat with Berkeley's Rich Lyons on stablecoins. We hope to see you this afternoon. Take care.